is the debt to GDP in Africa unsustainable, or is there any other direction we need to look at? I would like to ask Max to kindly open the floor and shed the light on this question. Thank you.
Yes, thanks very much, Otman, and thanks for having us on this specific panel, which is extremely important because local currency is a very timely subject. Now, to answer your question, I think that there are two things in my view. One is the macroeconomic positioning of our countries in Africa, right? So if you look at it, the first thing that you would notice is that in terms of income generation, like the countries have little capacity to generate the income from be it fiscal revenue or any other revenues or export revenues sometimes. And the second thing is there's a persistent deficit, right, that you notice in our countries when it comes to budget, right? And this is also linked to the first point that I have certainly mentioned. And then you will see that from our countries, there's a lack of capacity of getting as much local currency as you want, because at some point in time, there is also the depth of the capital market, local capital market sometimes also that is not there. And to add to this, there's also all the political certain instability that we see. All of this to say that economically, Africa is we're not strong enough as we should be, despite all the resources that we do have. Now, what are the recourses for us as countries? You have to go ahead and try to borrow in the capital markets, right? If what you need in terms of either budget deficit or to finance your infrastructure, you cannot get locally because you don't have that depth in reality of your capital markets, then you go and borrow externally. Now, when you go and borrow externally, I think that's where the issue of debt sustainability comes in. I think the question would have been, had Africa been able to fund itself totally in local currency like the US or France or the European countries, would we today say that Africa has a debt sustainability issue? I mean, if you ask me, I would say no. Why? Because our debt to GDP ratio across Africa in general is about 60%. If you look at any other countries, some of them are beyond even 100%, right? So, but with that said, and if you look at the way, you know, the international organization, including the IMF, look at debt sustainability, if you borrow in your local currency, it doesn't really affect your debt sustainability. So I think that the issue of currency availability in relation to your reserves now becomes like very crucial. So that's the problem that we have. And yet we do not export enough to get like lots of our revenues in hard currency. And then we face this issue of now currency, foreign exchange, because now you're trying to use your own local currency to buy foreign currency and to repay your debt. So is that debt unsustainable? Probably no. But we're facing an issue of being able to have currencies available so that we can pay off these debts. And then you have also the issue of rising interest rates, right, in hard currency, and the usage also. I think, in my view, of what we do when we do Euro bonds, are we getting Euro bonds to invest in viable projects that will generate revenue so that we can pay off? Sometimes no. So to me, I think that I would say a mixed response in the sense that debt sustainability, yes, it is an issue, but the factors underlying it are not really our capacity to borrow, but more our capacity to repay the foreign exchange currency debt that we have.
Thank you so much, Max. Martin, can I ask your opinion on this question?
Thank you, Otman. And it's a pleasure to be here with close partners. I didn't realize that all of three of you used to be with AFTB, so I'm the only one that did not used to be with AFTB. But we're obviously working very closely together as IFC, so with all the institutions, so it's a pleasure. So no, in my mind, and there's no question that I think as Max laid out and Otman and Isabel before, that the root cause, or one of the kind of root causes for the debt unsustainability is the mismatch So much more important than the level of debt is actually the mismatch of debt in terms of FX. And as was said, that really exposes borrowers to economic shocks, creates a downward spiral, pro-cyclicality, and it not only causes crisis, but it makes crisis much worse. Because it sort of, once you go into a crisis and you have that basically foreign currency mismatch, it actually quickly goes into a downward spiral and creates that boom and bust cycle. Now, as IFC, we are obviously private sector focused, so we provide financing to private sector companies and projects, and we mobilize private capital. We have our colleague from our mobilization group here. But we really see that effect with our clients as well. So at the private sector level, it often looks like a good idea to borrow in foreign currency for two reasons. First, rates are lower, though the interest rate differential can be very tempting if you want to save your interest cost. And second, in countries where FX is already scarce, it can sound like a good idea to borrow dollars because at least you get access to dollars. But if your revenues are in local currency, it's still a bad idea to borrow dollars. You're just kicking the can down the road. It can be a very risky strategy, and often the real cost turns out to be much higher. And that includes, by the way, concessional financing as well. Often concessional financing, long-term concessional financing in hard currency can end up being much more expensive in real terms, in local currency terms. Just to tell you a story of a client to illustrate, we had many years ago a client in a Southern African country who had a pretty large FX mismatch on the balance sheet. And one of our covenants was to control that. And we basically, before we signed the agreement, we actually were in very difficult negotiations so that you have to reduce that, otherwise you breach our covenant. And we had very tough negotiations because obviously the rate was much higher in local currency. And the client tried to convince us that, we are making their life difficult and so on. And in the end, they gave in and they were very unhappy with IFC. And within 6 months, the currency tanked. And for years after, when I met the CFO of that client, they were still thanking us. They said, if you hadn't insisted at the time, we would have been wiped out. This was just one of the examples where sometimes, if you are a lender, a financial institution, you also have a responsibility sometimes to provide the unpopular message and help your clients see this. And if you are a private sector corporate as well, I think it's really important to see that. But these effects aggregate at the macro level, and as I said, raises inflation, raises real rates, and then creates this debt spiral. Now, it's very difficult to change course once you're in the middle of a crisis, but even then, once currency is under pressure, there is no way around to go the hard route and redenominate your debt. Just to mention, I think there's a second root cause behind that, why it actually is so difficult in many countries to provide local currency financing or to avoid those mismatches, and that's really the fact that capital markets are underdeveloped. So it's very difficult to raise long-term financing. There's limited tenors, there's illiquidity, high nominal interest rates, etc. So without a functioning capital markets, it is not easy to raise local currency financing, and access is limited. So which is why we believe as part of the solution we need to develop capital markets. So that would be my thoughts. Thank you, Otman.
Thanks a lot, Martin. Olivier, can you have an additional word from you, how you see it also from the private sector?
Absolutely. From the private sector perspective, we believe that over the past decades, countries in emerging markets, and particularly in Africa, have been borrowing massively in international capital market. And this happened right after the global financial crisis. With the quantitative easing, rates were very low in developed markets. There was a large influx of liquidity, and you had a lot of investors chasing for yield, and they came to the emerging market to invest. And you've seen a lot of low-income countries in Africa and elsewhere starting to raise funding in international capital market. I calculated that between 2015 to 2020, there was on average 15 to 20 billion being issued by Africa into international capital market. So we went from a situation where these countries were out of EPIC and MGRI with a debt to GDP of around 20-ish, to a situation right before the COVID crisis of what Max indicated, almost 60% of debt to GDP. So that massive increase of debt, and mainly coming from the international capital market. Obviously, the market was not, worried about it as long as they were refinancing solutions. It was like the market will continue to be open and they will be able to roll over the debt and not face the consequences. But unfortunately, with the COVID crisis and mainly the Russian, Ukraine-Russian crisis, the market was short for almost 2 years. So the refinancing part was no longer there, and you had that refinancing wall coming, and obviously a debt sustainability issue. At the same time, that debt, which was denominated in local currency, with inflation rising, you had the local currency tanking. So the total volume of debt in local currency increased significantly, weakening the debt sustainability of the country. Compounded to that, again, what Max indicated, they raised hard currency funding for infrastructure projects, which in some instances didn't materialize or generate the revenue that they were expecting. We had a few instances of hidden debt also in Africa that affected the confidence and the DSA position. So overall, we have that situation where basically for a decade, Africa raised a lot of hard currency funding. But it wasn't only Africa that raised financing in hard currency during that period. If you look at developed markets, the debt to GDP, I guess Max mentioned that, the debt to GDP for the major developed countries is above 100%. But it is denominated in their own currency. So there you don't have the same problematic. And in Africa it's 60%, but we have that crisis. And the reason being that they are borrowing their local currency. So it's important to borrow in local currency. But I wanted to caveat though that in many countries in Africa, the local currency rate is also very high. If you go to Ghana, to Nigeria, it's at 20-something%. So that also can create a debt sustainability issue in local currency. And the past instance, the experience of Ghana, which restructured its local debt, proves that local currency per se is not the panacea. So the solution should be for countries to be able to borrow sustainably in their domestic market, to go around the original sins, but the sustainability is important. It needs to be competitive in local currency terms. Thank you.
Very clear, thank you. So if I may, just to summarize what was shared with us earlier on, that puts the stage quite nicely for the next questions. If we look at the the debt sustainability versus benchmarks, in Africa, we are not in a debt unsustainable situation. 60% of GDP versus the benchmarks for the rest of the world, we are lower. Which is in principle, we're actually decreasing the overall debt to GDP on a global level. However, the composition of your debt is as important, if not more important. If you borrow in a currency that is not yours, you are leading into an unsustainable situation. And that's what happens in many African countries. Their inability to generate dollars has led to their inability to pay back their dollar debt. So if we combine this with the fact that the capital markets in many African countries are underdeveloped, which is the case in many countries except maybe South Africa, if you compare to the emerging market countries who have 80 to 85% of their debt in local currency and a small share in dollar, there is an inability of the African countries to raise financing locally in their own currencies. So the next question, maybe I'll start with Max. What are the MDBs doing to offer a sustainable solution for local currency financing?
Well, as an MDB, we do offer, of course, financing in hard currencies, but we have the options for countries to borrow in local currency. Now, as an MDB as well, we do not take foreign exchange or interest rate risk. This is, one of the reasons why we are AAA rated. So what we try to do in the market is that, one, we go and issue local bonds, right, using our AAA. And the objective of that is not only to provide financing to our borrowers, but at the same time try to also to develop building a curve in the local market. That's something that we do. Sometimes issuing local bonds has also its limitations, be it regulatory limitations or the size also of issuance, because not all projects needs to, carry, has large amounts. So we also can do cross-currency swap with central banks or with commercial banks as well. We even had I know a few years ago with IFC, we had we had an agreement to a cross-currency swap whereby if one of us raises local currency in one country and the other one needs it to fund the project, then we can do a cross-currency swap amongst ourselves. We also can borrow directly from local commercial banks, and then we also provide guarantees in local currency, right? So if a country or project needs local currency, we can provide you with a guarantee in local currency so that commercial banks can use their deposit flow to fund the project, and we provide you with a AAA rated guarantee. The reality is that all of that is not enough, right? I mean, we must have other solutions. And like I said, the depth of the market is not there. And one of the main challenges also we have is that we are AAA rated. Most of the African countries in general are, let's say, single B rated. But when African Development Bank goes to that market to talk to the investors, what they're going to say is that, look, to me, the government is risk-free. So you, as your AAA, I will price you, above a little bit the government, which financially speaking doesn't make sense and causes also lots of issues. And all of that is linked to the lack of development of these capital markets. But these are the solutions that we provide to do so. And one point that I would like to add is most of our countries also are eligible, at least from the African Development Bank, to the concessional window of the bank. So we provide you with loans, 40 years. There's a 50% concessionality. But one of the main challenges we're facing is that you would provide a loan in hard currency, but because of the continuous depreciation of that local currency versus the hard currency, the whole concessionality that you have built from day zero, by the time they repay the loan, completely gone. Right, so it's something that we are trying to address as we speak. Our deputies had asked us to do so, but that's a real problem. Just to say that FX risk is a real problem for Africa.
Much appreciated, Max. Martin, can we have your view?
Sure, thank you. So yeah, we are obviously thinking a lot about it and doing a lot about it. So IFC over the last 10 years has provided, I think, more than $30 billion in local currency financing in actually more than 70 currencies. So we are obviously proud of that, but it's also clear it's by far not sufficient and we need to scale up much more. And if you drill into this, and that probably holds true for the MDBs and DFIs more generally, even those that have been quite successful in providing local currency financing, the bulk of it is in the most liquid currencies. And where we need to grow the most is in the less liquid currencies. And this is where things and everything Max said, etc., become much more difficult. But what's clear is it has risen to everybody's mind. So our shareholders, G20, the MDBs as a community, I think it has really, over the last few years, become much more of a pressing priority at high level to that local currency financing is a priority, especially in the context of the climate financing and the climate crisis. I think people have woken up to the fact that if we are providing the amounts of money that need to go into climate financing into emerging and developing countries, if we do this in hard currency, we are just laying the ground for the next debt crisis. And so we need to find ways way beyond the scale we have done in the past to provide local currency financing. And there's a lot of very high-level working groups thinking about this. But it's good to see there's a change of paradigm also. In the past, I think, and again, I'm speaking for the community, project finance, infrastructure projects, often, the focus was to make sure that your project vehicle is hedged. As long as the tariffs match the financing, that was typically the focus. And people have also realized, again, that's not enough. This risk stays in the system. If you denominate the tariff of a renewable energy project or of a toll road or whatever, if you link that to dollars, you start with a very attractive pricing, and over the years it becomes very expensive and creates ultimately the end users. The burden stays with the end users. So I think people realize sometimes it can be smarter to maybe take some level of interest rate risk rather than leave FX risk in the system. Concretely, I mean, we do issue bonds. We only recently issued bonds in Zambia, for example. Again, we issued bonds in 7 or so African markets locally, and we want to expand this. Maybe as a side note, Max, I'm happy to say that whenever we issue, we start the conversation with the same feedback from investors to say, well, government is the benchmark, anyone else coming in needs to, it would be at best government flat. But in almost all cases, we have come in quite significantly below government, and in Zambia recently we were able to issue at government minus 400 basis points, just to say. So there is, I think, we also see a change of perspective that even in local currency, banks, international, regional, even local banks and other investors are realized that within your risk-free portfolio that it's worth to have a diversification and there's a value to a AAA. So that's very encouraging because it enables us then to make the all-in cost for projects work. Because very often when we start to raise funding at government levels, we add our spread for the credit risk we're taking, and so then the all-in rate often is very challenging. Otherwise, our priority, really, our strategy is that we also realize we have traditionally, as a AAA community, we work with the best banks internationally with very high standards, but that creates offshore solutions. So you swap your dollar liabilities into local currency with offshore solutions, and that creates offshore pricing, which is volatile, which can de-link from onshore realities. So one of our strategies, we want to move much more onshore. We want to face more onshore counterparts. We want to borrow onshore. We want to be able to manage liquidity onshore over time. And we need to develop more flexible instruments for our clients. And partly, and this is lots of discussions, but we also believe we need to take some residual risk to do more local currency. We cannot basically sometimes, for example, we may not always be able to match maturities. We might need to take some refinancing risk, and so this is all early stage, but these are the kind of things we are thinking about. Last point, Max, you mentioned guarantees. So we do a lot of guarantees, but you might have seen the announcement recently at the World Bank Group Guarantee Platform. There has been a decision sort of at the context of our private sector lab that we want to scale guarantees and credit enhancement, de-risking much more than we've done in the past. And so World Bank Group has decided to basically consolidate all guarantees offerings at the World Bank Group based on feedback we got from investors, and I think announced that we want to triple guarantee issuance by 2030. So also to complement funded solutions and use basically the strengths of our AAA. Thank you.
Thank you, Martin. Olivier, there is a saying that tells you that one hand doesn't clap, and the multilateral development banks certainly try to set the standards for the markets to operate. But what do you see the role of investment banks, notably JP Morgan, into contributing to mobilize private sector interest to be able to lend in the local currency of these borrowers?
Thank you, Otman. The private sector is there to address the need of its client at the end of the day. And we are also responsible institutions. And an institution like JP Morgan, whenever we advise a corporate or country to issue, we also, in most instances when it's possible to do it, provide the edge associated. In the case, for instance, of West African countries that have issued recently, even in the past, where the currency is pegged, for instance, to the euro, even if they raise funding in dollar, we always provide them with the alternative to swap it back to euro, which is the natural currency for them. We are the private sector, and we are not, I would say, not in a position to subsidize local currency. So being commercial bank, we are not necessarily able to provide long-term hedges, but there are structures that can be put in place by clauses. You can raise a long-term debt, but we can provide you a two-year, 3-year, 5-year. So we can create a financial engineering to protect the client for the maturity which is available in the market. That being said, all the comments of my colleagues here are 100% relevant. We will be keen to provide hedges in Ghanaian cedi, in Kenya shilling and others, but guess what? The level are 20-something%. So coming to us to add, for the clients to aid themselves in local currency and getting a 20% rate, this is the market, and this is exactly what we will be doing. Maybe this is where we need to work more with institutions that have deep pocket like the World Bank or the African Development Bank to create the condition to subsidize this rate so that it becomes available. Because as we said, The problem is local currency granted, but also the affordability of the local currency. So it's very, very important what Max indicated, the brainstorming that the EDF deputies at the African Development Bank are doing to find a way to provide concessional loans in local currency to client. It's very important, in local currency to client at an affordable rate.
Very good, thank you. And it's certainly, maybe one way to do that is to try to transfer the concessionality from dollar into local currency and find a mechanism to do that. Having said that, I fully recognize your points that you made, the three of you, about the cost of local currency, which can be perceived at least as quite expensive. If the house is on fire and somebody would look for an insurance, which is the case for some of the countries you mentioned, certainly the cost will be quite expensive. However, we also have situations where if you compare, for example, South Africa, who have their cost in local currency through the local government bonds maybe at 10, 11%, they could borrow much cheaper in dollar, much cheaper than their own cost of funds. They don't do that. They continue to borrow in their own currency. But then if you go to some of the neighboring countries who have a similar cost in local currency, but they can borrow lower in dollar, they still continue to borrow in dollars. So there is certainly a mindset that needs to be changing among the sovereign countries, as well as through the practices that we have as a development finance community, to make sure that the example that Martin shared through the borrowers who thanked him a few months later about the fact that they took local currency is quite critical going forward. Now, if we zoom in a little bit further into the sovereign side, because here if you talk about local currency, I think the audience can be misled. We said at the beginning that the central banks need dollars. We don't export enough. We have dollars liabilities as central banks. We have the objectives for FX reserves, replenishment, and external debt that we need to honor. And here we're telling them we're giving you local currency. If you give them local currency and they need dollars, well, we will not have fulfilled our mandate. What is the product that could be scaled up in mobilizing more private sector interest from the offshore market, because the onshore market in terms of saving and mobilization is quite limited, to be able to offer synthetic local currency to these countries? And I would like to ask Max to give us a little bit more information and clarity on this topic.
Well, yeah, I mean, one of the reality is that African countries need hard currency that we cannot go away from, because the reserves are in hard currency, all the imports are in hard currency, so they need hard currency. But yet they need to be able to repay somehow in local currency, and that's where I think the synthetic local currency that you mentioned is important. Not only for the countries, but for the African Development Bank, for example, because I said earlier that we are AAA, we do not take currency or interest rate risk. So if we lend you in hard currency, we expect you to pay us back in hard currency. But the beauty of the local currency, the synthetic local currency loans that TCX is providing, I mean, Othman is a very smart guy. He had laid out all the problems, so we can say that TCX is the solution. But in reality, it is the solution, and to be honest, because like I said, for us, we cannot take FX or interest rate risk. What TCX provides is the possibility for us to give on day one hard currency to a country, but all their repayments are linked to the local currency interest rate. So they do not take FX risk in reality, because at the end of the day, what happens is everything is in local currency in their sense. The only responsibility that they have is to convert whatever amount is the local currency equivalent in hard currency and pay it to us. So which is a lesser risk than the FX risk itself, right? And it is a perfect solution for us. So, I mean, we've done this in many countries already. And I think that we need to scale it up. One thing on our side to scale up this local currency solution is to be able to have risk capital in local currency, where we can lend in local currency, be repaid in local currency on one side without impacting our AAA. But then on the other side as well, we need to be able to scale up this synthetic local currency solution, because in certain markets, in certain like the loans we provide can go up to 25 years, right? And sometimes that maturity, which is too long, may also cause a problem. But we need to get our education from our borrowers, countries, to be aware of this product as well, to be aware of the consequences on this product as well. Because if you default, or if that swap underlying this transaction has to be unwound, then there can be consequences. But in a nutshell, that's what we need to do, to be able to give them the hard currency they want, while at the same time they keep their exposures in local currency. And this has been really very effective solution for the African Development Bank in providing local currency solutions.
Thank you so much, Max. Before moving into the final recommendation, before you open the floor to questions, Martin, you have highlighted the cost issue, which is certainly a tangible problem that we need to solve. I believe that IFC, you have been able to find a solution with the help of IDA or the World Bank in general to support private sector lending in local currency. Can you share a little bit more about this initiative?
Sure, thanks, Otman. Maybe before, let me quickly also contribute to the sort of synthetic solution you mentioned. So before I come to a question, so what you highlighted is a discussion we have very often. Obviously, we also work a lot with TCX. We're probably one of your larger clients also as well. But we also issue offshore bonds, for example. We as IFC, we issue a lot of offshore local currency denominated bonds in international markets. We opened many markets, India, Uzbekistan, that became main markets, also in Africa, many African currencies. But we issue frequently to investors who sit somewhere around the world, have an appetite for local currency, but don't necessarily have onshore presence or the ability to custody arrangements, etc. And sort of the MDB community is a frequent vehicle to crowd in these kind of investors who have an appetite to take currency exposure on the back of our GMTN programs, which creates basically for us a hedge on the back of which we have often then done local currency investments. And then often when we discuss with central banks or sort of our shareholder governments, we often explain that if we have these offshore hedges, essentially we are providing capacity for local currency financing from entities outside of the market who are willing to take the risk, bring hard currency into the market to convert into local currency, and then later basically take out at the current spot FX rate. So the FX rate is hedged, but there's still hard currency coming in, to your point. So that's, I think it's a very interesting solution that certainly contributes, and that I think needs to be part of the toolbox of solutions that we're talking about. In terms of cost, yes, definitely. So we are, as a general sense, we are trying to have as many tools in our box. We're trying to use as many instruments. As I said, we use TCX, we use from onshore swap markets, offshore swap markets, onshore bond markets, offshore bond markets, borrowing from local banks, guarantees, but we also use blended finance. And we realized that in many markets where there is no market solution for the tenors we need, but there is a lot of value to provide local currency financing, especially by demonstrating capital market solutions. And in order to make pricing works, we use blended finance. We do this in a very sort of stringent way. We always want to make sure we don't distort markets. We have sort of a very stringent governance mechanism around it. So we're not just throwing subsidies out and sort of distorting market pricing. But so indeed, so the IDA private sector window has been a big partner. We created a sort of internal facility. We also work with other donors that enable us to do local currency. But for us, clearly, that's always just a transitionary mechanism to market solutions, because the scales we want to reach, we will never be able to do with blended finance alone. So it can only be able to catalyze and extend our reach.
Thank you very much. I would like to start with Olivier by asking a question related to how can we address the challenge that was put to the development finance community by the African Development Bank president that I mentioned at the beginning of this meeting. Be bold, be innovative, try to find solutions. So how can we be concrete about this point? What will be the recommendation that we could have among ourselves. I mean, we have the JP Morgan, one of the best investment bank and biggest in the world. We have the African Development Bank and IFC World Bank, who have basically, who are providing the biggest support to the African continent. What are the concrete steps that we could discuss in terms of recommendation so that when we meet in 12 months' time, we don't try to address the same question. We will be a little bit ahead of the point we are today. Olivier?
I'm laughing at one because I'm not sure that in 12 months' time we will have cracked the solution to find local currency, sustainable local currency financing for African countries. I guess everything that has been said before by Martin and Max is pretty much true. You have the synthetic local currency that exists. You have the IDA private sector window that helps subsidize. And as Martin indicated, it's not sustainable. I mean, if you take a rough calculation, you want to lend to Ghana in local currency. I mean, as I said, if you take a basic US dollar LIBOR or SOFR loan, you will swap it at 25%, 26%. That's the truth. Now, if you want to buy down this level to something which is a bit more sustainable, let's say 5%, it will cost you around, what, 15% times the duration of the loan? Like 10 years, that's 100%. So you'll be putting 100% in grant to fund 100% loan. Not sustainable. At the end of the day, the solution needs to be in the country, and they need to develop their market and ensure that the level of rate in their own market is also affordable. We spoke about the inflation. We spoke about the mismanagement of the currency. And for all those reasons, those markets are not, for the time being, able to provide let's say, sustainable local currency financing to their own members. So a solution has to be developed within the local market. The participation of the World Bank, I mean the AFDB and the IFC and the World Bank in general, to help develop those markets is key. And at the end of the day, my colleagues here also indicated it many times, these countries are, in most instances, resource-driven, once commodity-driven, and exposed to the volatility in international market. So you need that diversification. So you need international flows to come and invest into real projects, not portfolio investment. I'm talking about real investment to create new assets in order to be able to export them and generate hard currency. It's important that Africa generate sustainably the hard currency that it requires to meet its own need, not to portfolio investment, but to real local project and diversification. And I believe that the IMF have been doing a fantastic job over the past few years. We started by speaking about the unsustainability of the debt in Africa. I mean, when you look at what happened over the past 2-3 years, it's actually improving. And because of the fiscal consolidation, because of the IMF support. So we need to continue on that front for the next year. And I believe that some of the countries that are in a high and very, very distressed position today may be on the medium level in 1 year time, and maybe they will be able to afford a better level because the market itself also price loan to these countries in line with their risk. If they are better managed, if they have a low level of debt, they will also get, even in hard currency, a cheaper funding level.
Thank you very much. Martin?
Thanks. So from my side, first of all, most importantly, we need to develop capital markets. There's no way around. Now, it takes time. It's building an ecosystem. It's something we will not be achieved in 12 months, Othman, but we have to do it. In addition, something that's less talked about, but even I feel more important, is creating money markets. Creating functioning short-term markets in local economies. And so in terms of benchmark, having liquid benchmarks, floating rate loan markets, repo markets, etc., that actually create the liquidity based on which you have a price for liquidity at any point in time, and it allows banks to do maturity transformation. On that point, if I may, I slightly disagree with your point, Olivier, if I may. In terms of rates, I actually would like to say the rate actually doesn't matter. If your example, 25% versus 25% is unsustainable, 5% is sustainable. If you look at inflation in those markets, often the rates are 25% because inflation is 22%. The real rate is 3%. But I mean, as you say, the sticker shock is 25%. So people don't want to pay 25%. If you have money markets, if you're able to borrow floating rate, and you're basically at a rate that sort of reflects current conditions and resets, then actually the nominal rate is not the issue. So this is often a discussion we also have with clients. Yes, nominal rates are high, but they're high for a reason. But you need to start looking at real rates. So that's just a small side comment. Creating capital markets has to be a joint effort, and I believe it's an effort that all of us, everybody in this room, has to contribute. If you are a financial institution, if you are a issuer, if you're an investor, etc., taking the extra effort to create demonstration transactions, which can be costly and cannot be a short-term, often cannot pay off in the short term, but it's really a long-term investment, I think is really important. Having said this, so there's a sense of urgency. We don't have any time to lose. We have to, even in markets where the conditions are not ready, regulatory frameworks are not ready, capital markets are not ready, we need to do this sooner rather than later, also in the context of the climate crisis. And so with that, in terms of call to action, I think we need to create demonstration transactions wherever it works. We need to bring more issuance to local markets. We need to mobilize domestic resources. In many markets, even where capital markets are not fully developed, you have actually quite a bit of local savings already that often lack the mechanisms to be channeled into productive use. We need to crowd in offshore investors to the synthetic solutions. We need to work with partners like TCX, etc., and see how that can basically provide more, even bigger solutions. And finally, we have to continue keeping our eye on macroprudential regulations in the macro situations and macroprudential conditions, financial management. So there's no way around it, and this will be part of the solution. So, thank you.
Very much, very clear. Max,
No, I think very short. I mean, Olivier and Martin has already provided what we think, right? So we fully agree with that. The only point I'm going to say is, as MDBs, or African Development Bank, also we need to be able to take some level of risk on our own balance sheet to offer local currency, right? Because we cannot continue this back-to-back situation, which is not, sustainable. So we need to be able to set aside risk capital in the same way we offer dollar and euro, and offer whatever currency we have, taking the risk on ourselves without jeopardizing our AAA. So this discussion also has to happen at the rating agency level, but I think it's something that we must do, in my view. And I think also that from TCX perspective, we need to get you, because we are your members, capacity so that you can do more. I know you don't offer, for example, deliverable, right? I mean, we should also take a look at that to see how we can also offer deliverable, because also the synthetic local currency is a great product, but it has also a little bit of limitations sometimes for countries to get the normal or to exchange the local currency into hard currency at a very specific rate. So yes, great solution, but I think that as a solution going forward as well, the deliverable of these local currency also is something that you should take a look at as TCX.
Thank you so much to the three of you for sharing your views and exchanging on this important topic. We left 10 minutes on purpose. If there are any questions that should be addressed, please, madam.
Yeah, thank you. My name is Amag Benu. I work with Crown Agents Bank. All protocols observed. I have two questions. My first question is, it goes to Olivier. I just want to find out, has AFDB helped, structured, or supported the South region in terms of funding? I mean, it's the same currency everywhere. If you're talking about, I'm Ghanaian, so if you're talking about Ghana cedi and KES, these are two different currencies. But South region, have you helped structure some, maybe a loan from Senegal supporting Togo? That's the first one. The second question is, I think 2 days ago, the panelists, or yesterday, the panelists mentioned, one of the panelists during one of those meetings mentioned that local funding also impacts private sector investment and borrowing. So how are we able to marry the two? Yes, we are supposed to borrow locally, but we know that that can also affect private investment. How are we able to marry the two? Thank you.
Okay, good afternoon. My name is Amina. So I was wondering, I know towards the end, there were some comments that sort of touched on what I was thinking. So I'm wondering, when IFC or AFDB raises local funding and then adds a premium and then, lends to the local market, how does that impact pricing? And how does that impact, pricing? I'm just wondering, would it be cheaper to empower institutions like AGF, African Guarantee Fund, who guarantee capital raise? Would that sort of facilitate the market to think more in that direction? And it seems to me there's a message in there, right? It seems like the local companies or the local borrowers can actually access that funding locally. Some of the funding they're coming to you for, they're supposed to get it locally. So I think the messaging is perhaps there are certain things we're funding that we're supposed to encourage the institutions to raise from their local markets. And I'm just wondering if we would consider technical assistance that would deepen the capital market. Would that be a more long-term solution? Because raising local funding and then round-tripping, it just adds to the cost, doesn't it?
Thank you very much. Vivek Mittal from AFIDA Africa. Huge fan of all the work that all the institutions are doing. I've heard Martin speak for the last 8-9 years. We're good friends of TCX, going back 15, 16 years since it was set up. What we find is the room next door is talking about mobilizing local currency. And the people over there say regularly that actually, the interest rate is a wash on a hedge basis. I would like to see what are your instruments doing in increasing tenor? The impact of a 1-year increase in tenor mathematically is way more powerful than a 1% reduction in interest rate. So tenor is the issue as far as we are concerned in infrastructure. The second thing is there is a huge complexity because across Africa, we run an accelerator with 17 startups raising $5 billion, first-time developers in energy and infrastructure. There is a lot of confusion between when tariffs are locked in, when construction starts, when operations start, and the debt starts repaying. Hedging becomes very, 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 very expensive in that process. What, if any, ideas or solutions? A, do you see the issue? B, what can we do about it?
Thank you. Let's provide some answers. We'll provide some answers and then come back to the questions.
Okay, so I can quickly address maybe Amina's questions and I forgot your name, sorry. Vivek, that's right, Vivek's question, to some extent at least, but I think I won't be able to fully answer. But in terms of Amina's question, so I think you are absolutely right. The end goal is not for DFIs to intermediate and provide funding. Ultimately, what we want to working towards is to enable borrowers to access markets directly. So in the end, I mean, a deep, liquid, vibrant capital market will have many issuers from AAA to startups and others, who can raise capital, and investors can choose based on the level of risk appetite, etc. And it is a big priority for us. We do provide lots of technical assistance together with the World Bank. We have a program called JCAP, etc., that aims to facilitate capital markets framework functioning, but also actually creates issuances. But we also help issuers come to market, and we do this through guarantees, like you mentioned, like the HEF or DAS and other institutions. But we also provide anchor investments. So we found that just being an anchor investor, putting our name behind an issuance and telling the market, we have approval to invest in this issuance, is actually very impactful. And so we only last week we came with a large bond in international markets. In the region, for example, in Tanzania, we supported CRDB and NMB with large first-time social and sustainability bond issuances. In South Africa, we support a number of issuers. In West Africa, just to quickly say, we had, just to tell you, in XOF, and in part to your question as well, we brought some very innovative transactions to the market where we would be an anchor, we help structure, we anchor it, so we are part of the investor, but actually we invite capital markets investors. One issuance, one of the most recent securitization was by Sonatel, a first-time telecom securitization in the market that used the receivables. One that we did a quarter before was I think, I'm not aware of any other transaction globally, was an electrification receivable securitization called PUPT in Cote d'Ivoire, where we basically securitized the receivables associated with electrifying poor households, part of the national program for electrification, and brought this to the market. It took us 3 years to structure, and so on, was a very successful transaction obviously with partners. And these are examples where ultimately we want to have many different instruments on the market so that investors can invest. And you are right. And maybe one more comment. You know, we are financial institutions. We need to make we have to run our financial model. But since we're dealing with private sector, if our rates are too high, our clients will walk away. So transactions only work if they work for our clients in general. So that's with regard to your question, Vivek. I think there's a lot in there. Swap costs are often high for a reason, because there is no liquidity. And you can do a lot. I mean, you can, again, it comes back to the rate question that Olivier highlighted very much. Often there is a sticker shock around the cost. But you can also do lots of smart things. You can do proxy hedging. You can hedge to kind of part of the tenor. You can hedge to a basket of other currencies, etc., to kind of manage that cost. Secondly, I think if I understood your second question on startups, did I understand this?
There's a huge structural challenge, and that's
Loan tenor. What are we doing? Okay, my last point. Loan tenor, yes. So we actually often get involved when we see that we can extend tenor. So many of the transactions I mentioned, for example, we would not get involved in the 10th issuance of the same tenor. We're trying to expand the tenor, and you're absolutely right. I think you made that point very eloquently. Expansion in tenor in markets has a huge impact on borrowing cost, and there's a lot of appetite by investors. So expanding tenors, expanding ability for borrowers to borrow in longer tenor is something where we feel ultimately that's the role of capital markets, beyond what banks can provide or should provide. And this is why we actually often work with our clients to see if they need longer tenors, can we work with them? And again, our presence, can that help investors be comfortable to invest in even longer tenor? Let me stop there.
Maybe I'll just add that a point on that tenor. I think in addition to what Martin said, I think the guarantees we provide really are also solutions, because we are AAA rated, like Olivier, for example, will look at our guaranteed loan as 0% risk weight. So it allows him also to extend tenors of the loan. We recently did a transaction in Senegal in local currency, whereby we're able to offer them, using our guarantee, 20 years, right, in local currency. So the extent of the guarantees used have to be scaled up if you want to do more. But I think that the fact that we are able to assist in that regard is something that is important. On your second question on the energy issues, like the energy project, yes, hedging there is extremely expensive. But I think the starting point is for all of those PPAs, for example, to be denominated in local currency, because all of them mostly is something that the bank is trying to push. But the reality is that all these contractors, they coming in, they want the PPA to be in hard currency. So then, you're running into another. I mean, the issue remains the same, because the obligation of those countries or those SOEs are in hard currency. But it is correct to say that the hedging there, given the uncertainty of the project, is extremely high. I think that we do. Ask question. We do provide TA ourselves. We have a division that only does that, capital markets development. They do TA and capacity building to help stock exchanges, for example, and even people understand the market more. And on the question on AGF, it's very interesting because, yes, we try to leverage on the local players because they are more able and more nimble to provide local currency sometimes, or most of the times, I should say. So AGF, for example, we have a AFAWA, which is Affirmative Financing Action for Women, where we're providing them a counter guarantee. We say, go ahead and guarantee all of these local financial institutions so they can all lend to women, but then we take part of the risk of the portfolio because sometimes it is what we do. And in addition to that, what we have recently introduced is to work with those same agencies, be it local commercial banks or entities like AGF, and we say to them, look, we have a project in this specific country. We just give the liquidity. We will take all the risk as if we were providing the loan. So for them, they just provide the liquidity. They're not taking any risk. Even if they get sued for, I don't know, environmental purposes, the bank will take that risk. So this is also to get them the comfort that they need so that they can provide local currency.
I will just concur with what has been said, particularly for Vivek. I mean, for those infrastructure, long-term infrastructure project, I mean, we can also do pre-hedge. You don't need to hedge on day one every of the cash flow till maturity, but when you start the process, you can talk to bank like JP Morgan, and we can provide you with a 2-3 year hedge for that construction period. And when we get to another phase, we can design another hedge solution, and we can involve our friends here from the MDBs. We can involve MIGA to provide the guarantee so that we can extend a long-term 20 years hedge. So there are solutions. We know that in your case and for a lot of infrastructure players, the cost of the edge destroy pretty much the return, so that you end up in a situation where infrastructure projects in Africa are actually less interesting than what you get in Latin America and others. So it's something that is very compelling, you're right, and it's something that the MDBs, the international community, needs to find a way to protect investors like yourself to make sure that you get the level of return that is warranted by your investment.
Two very small additions before we take maybe a couple of new questions, because we are going ahead of time. First one is, when you talk about climate finance, if you take all the onshore resources, so the local savings, as well as the firing power of the multilateral development bank, plus the secured private sector interest to finance climate change, it's not enough. So the reality is, if we use all the tools that we have, we will not be able to achieve the targets that we have set to ourselves. So the offshore markets are not competing with the onshore markets. There are some idle funds that could be mobilized locally through some of the guarantees in institutions. They should, but this will not be enough because there is not enough saving. We need to bring saving from the rest of the world through the MDBs, the private sector, to increase the firing power. So these initiatives are not competing with each other. They should all be scaled at the same time. And maybe one point on the infrastructure hedging. Well, Olivier mentioned 2 to 3 years, but Olivier can also come to me, and then he says, I have a client who wants to do 30 years, and then we give him a hedge for 30 years. So, and this is our role, the additionality. The problem is original sin. You cannot have a tenor for your financing in the local market as long as the needs of your project. So we have done 25 years for a water a project. We can also commit into a pricing that will be stable during basically the commitment period. We don't have any pricing uncertainty. You can commit to your counterparties, to your investors, that the cost of debt will remain the same. There are solutions. And it's all this to say is that the TA is very important. I'm pretty convinced that many of the governments who are borrowing in dollars, they simply don't know that they could borrow in synthetic local currency. Many actors in the infrastructure sector are not aware that these options could be possible. So the way we communicate and advocate going forward will be critical. Thank you. Maybe 2 more questions? You decide. Yes.
Thank you. My name is Lad. I work with the Central Bank of Nigeria. And yes, to the ADB and IFC, when you extend loans when you give lines of credit to deposit money banks, do you monitor the rate at which they on lend to the customers? Because I used to take part in the country strategy annual country strategy, whatever, of the ADB. And there was a time like 10, 15 years ago, we discovered that you didn't have a strong monitoring mechanism on ground. Then, I don't know now if you have improved on that. And you did mention now, the moderator, that some companies can take loans in local currency. What if they need to get some raw materials in foreign exchange? How would they do that? And finally, somebody mentioned here developing, I think that would be, sorry, is it JP Morgan? No, you.
JP Morgan.
No, you.
IFC.
IFC. Developing short-term interest rates in money market, yes. Can you please talk more on that? Thank you.
Thank you so much. I want to speak on the behalf of young people. I'm a master's student pursuing Master of Science Development Finance. So with regards to AGF, you've talked of AFAWA. Where are the youths? Can we also have guarantees only specific for young people? And then one of the speakers mentioned about financial engineering in terms of enhancing debt sustainability. Can we now talk of maybe African Development Bank or other central banks, digital currency to leverage on the fluctuation of the interest rates? Thank you so much.
Hi, Parko Tekle, Crown Agents Bank as well. Just knowing what TCX does, obviously meeting a very unique demand in the market, I'm just curious, how do you think about sort of the universe that's needed to sort of create more players who have that sort of unique appetite for frontier and emerging market currencies across the spectrum? So we work at Crown Agents Bank. We channel a lot of demand on a very short-term basis from, let's say, the international development organizations, the likes of the UN World Food Program, and move that local currency demand into markets where maybe there's a central bank who's also looking for a liquidity solution to basically use local currency to help service some external obligations they might have, leveraging off that natural local currency demand that we're able to channel to that country. So I'm just curious. It seems like it's still a very niche space. I'm just curious to get your sense of how you guys view the market and what the opportunity set is for more players to get involved to create more demand for these local currencies.
Yeah, excuse me, sorry. I think my question on the private investors was not answered. Yeah, thank you. Okay, so I mentioned that, was it yesterday, one of the panelists mentioned that when there's local funding, borrowing from the government, there's always a disadvantage on private investments because that means they are taking funding from the middle level economy to the government without investing more in the private sector. That I just want to find out that how are we able to marry your statement with that one as to whether the government should borrow locally, eventually it affects the private companies. They are not able to borrow from the commercial banks to produce more or to manufacture more or to hire more people. I just want a bit of insight on that. Thank you.
Okay, maybe I'll start on that question. Look, in my personal view, I think liquidity in the local currency, I'm talking about like commercial banks, the liquidity that they have, or I would say even the insurance investors like insurance companies, it's very rare that you see that there's a shortage of liquidity in the market, in my view, right? If you look at like in the ZOF market, you see that there's plenty of liquidity in local currency. The issue is being able to deploy those local currencies, and sometimes what they're requesting, right, for them to deploy the local currencies may be very demanding. I am not personally convinced that because government is borrowing in the local market that it crowds us totally the private sector. I'm not totally convinced of that personally. Maybe, you know, Olivier and Martin may have another view, because I think that there is enough liquidity. Where I think sometimes the issue is the comfort or the lack of comfort that commercial banks sometimes have to lend to our entities. And then the second point is also the lack of development of the capital markets, right? Because if you think about it, if you go to other developed countries, governments, they borrow as much as they want, and the private sector is able to borrow using different sort of mechanism. But rarely, if you come to the XOF market, rarely do you see a private company going into the capital market and issuing a bond, for example, right? Most of our capital markets are driven by the sovereign issuers. But, you know, interested to hear what Olivier and Martin have to say on that. I think on the question of the lines of credit, it is a very valid question, because we cannot provide, we cannot reach out to the SMEs ourselves as MDBs. We don't have the capacity to do it. So we do it through local commercial banks, be it in hard currency or in local currency. Now, when we provide them we don't monitor, because they handling their own risk. We cannot monitor the loans that they are providing, right? Because they can come in and say, well, I gave this loan at this rate because this is the risk that I am facing. So we cannot monitor on a loan-by-loan basis. We have improved in the sense that now we agree sort of on a pipeline of transaction that they have to undertake, and there is supervision that's done on a yearly basis, right? So that the consequences are drawn. However, it's not yet perfect as you should be. We do not monitor on a loan-by-loan basis because we're not taking the risk of the small and medium enterprise. We're taking the risk of the commercial bank. So it is for the commercial bank to pay us back. So we cannot dictate to them who they're going to lend to and at what rate. However, it's acknowledged, and then it is something that's being done. On the youth questions, I think that guaranteeing youth, similar to what I just said on the SMEs, is not what MDB. The MDB, they do it through commercial banks, right? However, what the bank has done is that we have created, what we call the YEEP, the Youth Entrepreneurship Investment Banks, in countries that the bank is sponsoring and capitalizing with the countries and dedicated only for youth, right? So it's something that we've done already in Nigeria, in Ethiopia, in Liberia, and then Kenya is coming up, Botswana, I know, Senegal, Cote d'Ivoire, all those countries are coming up. So youth entrepreneurship investment banks capitalized by the bank and the country, only dedicated to youth. But let me get my colleagues maybe to complement.
Maybe to complement this question on the cost and the crowding out of the private sector. I mean, we've observed it in some African countries, maybe even here in Kenya, last year and the year before, when there is a balance of payment issue and rates are going very high. Commercial banks, they tend to invest most of their liquidity in government bonds and having very good financial year return. We've observed it across. So it's, and you're completely right, it's important for the central bank and the government to create conditions for those banks to direct, part of the savings to a real project. And one of the ways to do it is what we said, throughout this session, is they need to fight inflation, they need to diversify the economy, they need to find ways to bring that yield, T-bill yield at a level where commercial banks will have to go elsewhere to find new investment in order to generate the return that they want. At 25, 26 level, I'm not surprised that most of the commercial banks are piling the maximum of cash they have into government securities, which create actually additional risks for the entire system if ever the government were to default. But yeah, you're right.
I completely agree, Olivier. So on my side, I try to be very short. I know we are over time. Maybe just quickly to answer from the Central Bank of Nigeria question, credit lines, as well as, by the way, our risk-sharing facilities, because similar to what Max mentioned, we have these programs where we actually share risk on a portfolio basis, share the portfolio risk with banks on the underlying portfolio. So we take SME risk, agribusiness risk, many different sectors to encourage banks to lend more. But whether we give a credit line or we do these programs, we do monitor rates, but we do not prescribe generally. because we found generally that prescribing rates will not help in actually providing more credit to underserved sectors. Ultimately, we believe in competition, so creating offer and creating ideally, you know, an SME or agri or young entrepreneur, whatever, would have different institutions, different banks to choose from, or even non-bank financial institutions that we sometimes invest in, microfinance institutions, etc. So that the more choice you have, the better the rate will be, hopefully. But I think it's a very valid question because we obviously do observe that cost of credit in many sectors is still very high, and it is definitely an issue. So we would completely recognize, but maybe there's other things we can do. Would love to hear also your suggestion. In terms of the other question, just very briefly on money markets. So we're happy to take it offline. It's really a large ecosystem. We work with partners, we work with other DFIs, we work with you know, World Bank, IMF, Frontclear and others, and local partners, central banks. But it's really about creating, I mean, an ecosystem, the legal framework, benchmarks, interbank markets, etc. But we also support it as practitioners by lending against floating rate benchmarks and sometimes discussing with our clients whether it's not more prudent to take floating rate loans rather than fixed rate loans, etc. But happy to discuss more offline. It's a bit of a novel area, generally, I think, for most MDBs to engage more in money markets because we are traditionally more focused on the long-term financing. And finally, so I think the young people question, youth, I think I partially answered. We have for these programs, I think it's very important. Creating jobs is important. And we try to sort of work with lenders to see if, as Max mentioned, through financial institutions, whether we can support fintechs also. We're also thinking about creative industries, how we, for example, can support more creative industries, etc. But so it's a very important priority for us to see how we can contribute to creating jobs and supporting youth. Thank you.
Thank you very much. There are a couple of questions that were not answered, but I promise we will stay a bit longer to address them. I have to close the meeting now because some of us have to go to other meetings. I would like to first thank the panelists, Martin, Olivier, and Max, for your great contributions and looking forward to hopefully implement some of the actions you highlighted. And I would like to very much thank you also for your presence at this panel discussion. Thank you.
I'll give you a call. So we've looked at this in Nigeria. So we said, like, listen, solar program is much cheaper if you have it in Nigeria. Longer, but focus on better extension. This issue of creating part of the, looking for a dual, it becomes very complicated, and we need
Good afternoon, ladies and gentlemen. I'll say that again. Good afternoon, ladies and gentlemen. I don't know if no one has heard or no one wants to answer, so we'll try that one more time just to get people's attention. Good afternoon, everyone. Thank you, that's much better. You are welcome to the Zanaco side meeting. For those of you who don't know, Zanaco is the Zambia National Commercial Bank, and we are very excited to be here this afternoon to take you through what we know will be an extremely insightful discussion. We will be talking about the agriculture value chain and how financial institutions can support the growth of the value chain. We have some really exciting and great panelists that will be joining us on stage shortly from the British International Investments, from Rabo Partnerships, which is a 100% subsidiary of Rabobank. We also have the Africa Development Bank and Zambia National Commercial Bank that will be joining us on stage shortly. But before we get into that, allow me to introduce myself. My name is Chanda Chime Katongo. I am the Executive Head of Client Solutions at Zanaco, and I'll be your moderator this afternoon. So before we start, I'm sure a number of you are wondering what Zanaco is, who we are, and what we're all about. And so my colleague, Charlie, is here, and he will take us through an introduction of the bank. So I will give him a proper introduction by reading his profile. Charlie, I'm sure you'll like that. All right, so Charlie is a financial services expert and strategist with a background in corporate sales and leadership and a career covering agriculture, insurance, and finance. He holds a master's degree in development finance from Stellenbosch University, a Bachelor of Science degree in agriculture economics from the University of Zambia, a diploma in insurance studies, a diploma in sustainable business leadership from the Swedish Institute, and a certificate in leading sustainable corporations program from the Said Business School at the University of Oxford. Charlie is also a Harvard alumni and with the Executive Leadership Program at Harvard Business School in Boston, Massachusetts. So Charlie, please join me on stage as you introduce Zanaco and say a little bit about Zambia, the country that we come from. A big hand for Charlie, please.
Thank you very much, and I couldn't recognize myself when you were doing the introduction. I'll need help with the slides. Having said that, I also like introducing myself as a non-practicing smallholder farmer, having been born in a family that was doing smallholder farming, a student of agricultural sciences, an extension officer, having worked as an extension officer before. So I feel very at home when I'm discussing any topic that has to do with smallholder farmers. Having said that as well, we need to pay the bills for the bank that bought air tickets for us to be here, and that's Zanaco. So the next few slides will just share a little bit about Zanaco and give a high level of the topic that the experts will unbreak as we start the conversation. Something about Zambia, the country where we are coming from. Technology is not with us today. Just a few things that you would like to know about Zambia. The population is about 19 million people. The split between men and women is 47-53. Land mass is over 752,000 square kilometers. We've got a growth projection of between 2.7 to 5% from 2023 to 2026. Our life expectancy is about 65 years. We've got a relatively good cellular subscription, which is over 100. And then inflation is at a place that we are not very happy with, but there are interventions that are coming through, 13.8, quite high. Interest rates are averaging 26%, another high metric that doesn't help production. Exchange rate, not very good, but we're hoping that things can change. It can change. As at April, it was around 25.37%, and the statutory reserves were recently increased to about 26%. And I'm sure you know the impact that the adjustment will have on the financing sector. And in terms of Zanaco, the bank was established in 1969. The current shareholding include Arise BV, that is based in Cape Town, having 46% shareholding, and Arise is made up of the Rabobank of the Netherlands, FMO, and No Fund. 25% is held by IDC on behalf of the Ministry of Finance. 10% is held by NAPSA, or National Pension Scheme Authority, and 19% is free floating on the stock exchange. We've got about over 1,300 employees. We've got over 5 million registered accounts. We are accredited to GCF. We've got 188 automated teller machines, 62 branches, and of course over 27,000 agents across the entire 10 provinces of our country. I thought that we can touch base slightly and very briefly around what the topic will look like, and this is value chains in the smallholder space. So this story is very well known, and I must mention that just last week, Africa was celebrating Africa Day, and during those celebrations in various countries where we were commemorating our forefathers that liberated us from the rulership that the continent had. But one of the freedom fighters that we currently have, in my view, are the smallholder farmers that are trying to fight and free us from poverty that is ravaging the continent. So it's important that we have that in mind and just ask ourselves, what can we do more for these smallholder farmers? And that's what the panel will dive into. But a few characteristics: they are very subsistent oriented, just growing enough for their families, low productivity, they rely mostly on rain-fed agriculture, very labor intensive. If you've seen them cultivating their fields, you agree with that. They use a lot of traditional techniques to grow their crops. They are very vulnerable to climate shocks. I think in the recent past, Kenya did experience the floods, and we know how devastating that can be. And of course, limited access to credit and extension support. So the panelists will try to respond to some of these challenges as we discuss the smallholder farmers. And with that background of characteristics, we need to look at some of the interventions that can help unlock the opportunities that smallholder farmers have. So one of which is partnerships. And just the set of panelists that we'll see is a demonstration of the partnerships that we try to push as Zanaco. And we do know that we can leverage and use resources and expertise that are found in partnerships. Partnerships also bring about the strengthening of advocacy and influence for smallholder farmers. So it's creating the voice of the farmer. And of course, through that voice, the governments can provide an enabling environment for agricultural production. And of course, partnerships does work on improving access to markets and the value chains. The other intervention is access to finance, and I think most people would attest that it's a huge requirement, increasing access to financial services among smallholder farmers is very, very critical. And of course, increasing financial inclusion. So expanding coverage of rural sectors, rural banks, MFIs, reducing the cost of funding, et cetera. Those are some of the interventions that we need to be seeking. Introducing educational programs for financial literacy and leveraging digital technologies such as mobile banking and any other digital solutions that can spur the productive capacity of smallholder farmers. The last intervention that we will go later in details is infrastructure development. That is very critical to unlock the opportunities that we find in smallholder segments. And of course, policy and regulatory support. So from an infrastructure perspective, do we have irrigation systems? That is very key in as far as combating the risks of rainfall climate is concerned. So how can we support smallholder farmers in that space? Rural road network to open up access to markets for produce, and of course, agricultural reforms that are more friendly to smallholder farmers. These are some of the things that we'll dive into, and I thought we would introduce Sanako for now, and thank you very much for listening.
Thank you for that presentation, Charlie. Charlie, I actually forgot to give you a title. So as I was taking a seat, Robil says, you forgot to say his title. So thank you, Robil. So Charlie is the Chief Commercial Officer at the Zambia National Commercial Bank. That's at Zanaco. So ladies and gentlemen, we'll quickly now go into the actual panel discussion. And I said earlier that this is going to be a very exciting one. So I'm looking forward to it. Before we start, I just wanted to acknowledge the presence of our Secretary to the Treasury, who is in the room, as well as our Deputy Governor Administration. Thank you so much for joining us. For Bank of Zambia, thank you so much for joining us. It's good to see you both. Okay, so I will start by introducing the panel. And we'll start with our hosts. That's the Africa Development Bank. So Robil, we start with you. So Mr. Robil Durowoju is currently the country manager at the Africa Development Bank country office in Zambia. Robil, a Canadian citizen with 30+ years experience, has established track record in effectively engaging governments and key global private sector actors in high-level policy dialogue, catalyzing policy change under challenging economic and political settings, and supporting development initiatives through innovative project finance. Robil served as the country manager for the Sudan country office of the Africa Development Bank before heading the Zambia country office. He holds an MBA with the Delta International University in the United States of America and a Master and Bachelor of Science degree in agricultural economics from the University of Ibadan in Nigeria. Ladies and gentlemen, join me in encouraging Robil to join us on the stage. Kindly take the second seat, Robil. Robil, the second seat. Thank you. With us today is a lady from Rabo Partnerships. Rabo Partnerships, as I mentioned earlier, is a 100% subsidiary of Rabobank. So our panel is a mix of commercial banks as well as DFIs. So an interesting conversation we will have. So Roswitha, no. Rose is responsible for the strategy and rollout of data-driven inclusive business ventures in Africa within Rabo Partnerships, a 100% subsidiary of Rabobank. She started her career at Rabobank as a trainee and fulfilled several positions, mainly focused on delivering the agriculture strategy of Rabobank to the bank's subsidiaries and clients. The subsidiaries include Zanaco. From the 1st of August, she will start as the operations director for a new Rabobank-linked blended finance facility called Smallholder Agroforestry Finance BV, an organization that will fund agroforestry projects with smallholder farmers. Rose, kindly join us on stage. Lastly, we have Mr. Ndaba Mpofu, who's with the British International Investment. Ndaba is an investment director and head financial services debt at the British International Investment, formerly CDC Group, which is the UK's development finance institution and impact investor with 75 years experience investing in Africa, Asia, and recently the Caribbean. The BII has so far invested in 65 countries, has a portfolio amounting to 8.2 billion as at December 2022, and has offices in 13 locations, 6 of them in Africa, with the aim to create more productive, sustainable, and inclusive economies. Ndaba is responsible for building and managing the BII's debt investment program into the financial services sector in all their coverage geographies. He holds a Bachelor of Science honors degree in economics, a Master of Philosophy degree in development economics from the University of Cambridge, as well as a Master of Business Administration degree from Henley Business School. You're welcome, Ndaba. So, ladies and gentlemen, as I mentioned earlier, we are in for a treat with a discussion on how financial institutions can support the agriculture value chain in Africa. Okay, and we will start with our host, Robil. So, Robil, just to set the tone for today, and we know Charlie has done his presentation and it gives us an idea of our discussions. I would like us to focus on how financial institutions can support small-scale farmers. We will then move into innovation. So what innovative initiatives can financial institutions introduce for small-scale farmers? And then we'll go into climate-smart agriculture because this is very topical at the moment. In Zambia right now, we're going through a drought. We've lost over 1 million hectares of maize due to the drought. So this is very topical for us, and I would like us to address it. But to start, let's just talk about small-scale farmers. So, Robil, give us an overview of the agriculture sector, the importance and its importance to the African economy, and then just take us through some of the challenges that some small-scale farmers are facing, especially when it comes to access to credit, access to knowledge, access to networks as well, and how financial institutions can actually help to address these challenges.
Thank you very much, Chanda. By the way, you're right. You know, when Charlie was doing the presentation, I was like, okay, maybe we should just take questions and then we go home. I think he did half of the job for us as panelists. So thank you very much, Charlie. Now, the question we start with is very loaded, so I would like to take them in three sets. In terms of the overview of the sector and importance to the African economy, you know, when you talk about the agri sector in Africa, this is a sector that employs over half of the workforce. And when you break it down in terms of the smallholder farmers, about 60% of the farmers are smallholders in Africa. And then you think about the output and the productivity, they only contribute about 35% to the GDP of Africa. And then you want to think about what is happening, the changing demographics in Africa in terms of the rising population and the movement to urban centers has actually increased demand for food, which has actually also led to increase in net food imports. And this actually is estimated to increase up to 110 billion by 2025 from about 35 billion in 2015. So you see, in terms of the number of people that are involved in smallholder farming in Africa, there's a huge space there for financial services institutions to actually reach out and do business with these people. And in terms of the importance of agriculture in Africa to Africa or the economy. Now, if it's well channeled, if the potential of the sector is actually achieved, you discover that it can actually drive industrialization. And it can, because when you talk about value addition, you know, even the issues of production of cereals, vegetable oils, and all that, and the entire value chain can actually lead to industrialization. And once you have value addition, that increases the revenue that comes to the countries. And when that happens, you have excess, then you can also export, which can also lead to generating foreign exchange. So it's very important. The agricultural sector is very important to Africa. However, we have not been able to fully exploit the potentials of the sector. So I'll stop that in terms of the first part of the question. In terms of the barriers to smallholders farmers, now when you look at access to finance for smallholder farmers, in actual fact, if you talk about the entire agricultural sector in Africa, on the average, only 40% of credit that goes to private sector goes into agriculture. And this can be as low as 10% in low-income countries in Africa. So it tells you that something is not right, because we just talked about 60% of the farmers in Africa are smallholders, right? And we also said half of the workforce in Africa is actually in the agricultural sector. So that is huge there, you know. Then you see that credit penetration or the financial availability to smallholder farmers, which ranges from 40 to 10% in Africa. So again, it tells you that there's still huge space for us to actually do more. But then when we look at what are some of the reasons that actually leads to this, I think in the presentation Charlie made, he mentioned some of them. One of them, of course, is the high risk perception. I think for those of us that were in the hall this morning at the opening of the annual meetings, I think that's probably why one of the things that President Ruto actually asked the African Development Bank to do is to create an African credit risk agency, because he talked about the issue of Kenya going to the market, but have to pay 200 basis points more because there was something that happened in Niger, and somebody sitting in Washington thinking that Niger and Kenya, they are in the same space. So it's the same thing. When you look at the small, especially for smallholder farmers in Africa, the fact of the matter is that their production, their productivity is even at the instance of weather, right? So the market fluctuations is also there. So it's perceived to be high risk. So that's one of the reasons why financial institutions are not adequately engaging with smallholders. The second thing I want to talk about is, I hope I'm not taking too much time. Okay. The issue of lack of collateral. We also know that most of the smallholder farmers, the collateral what they own is the land. But we also know that across Africa, because of the land tenure system, especially for women, they don't even own the land. So they don't really have tangible assets to be used as collateral to get financing from financial institutions. I think Charlie also talked about briefly about the financial literacy. It's either lack or none for smallholder farmers in terms of financial services and the loan requirements that are available to them. of course, then you have to talk because of the special nature. You have so many smallholder farmers. Then you have to talk about the high transaction cost of actually banking and providing financial services or credit to these smallholder farmers. Because I know you as bankers, you know that the cost of processing credit to a big farmer is probably the same as a small farmer. So why would you bother about the small? It's all about the bottom line, right? And lastly is the issue of inadequate loan products, which are not particularly targeted at small farmers to take care of their seasonal cash flow and give them flexible repayment terms. So these are some of the things that I can talk to in terms of the things that actually preventing them to have access to credit or financial services. Now, going to the last part of your question, you asked a very loaded question. So there are really three parts to that. So again, thanks to Charlie's presentation, talked to some of this in terms of how financial institutions can address these challenges. I think the first one is actually leveraging on technology to come about new models in terms of digital financial solutions, which could actually allow us to reach in high numbers, these small farmers, which could actually reduce the cost of reaching them. I think it was mentioned in the presentation. We have to think about financial inclusion. It's very, very important. We have to leverage technology to make sure that we do this. One other thing we might also need to look at in terms now in this area of climate change is the issue of micro insurance products. Some of them might even be weather indexed that might actually help us to and adapt it to smallholder farmers so that I know that there's some of them that are already out there. So we actually need to leverage on these products. And the last one I want to talk about is...
in summary.
In summary, yeah, just give me 2 minutes, I'll summarize, because I've not talked to you about what African Development Bank is doing in this space. And I'll quickly use 2 minutes to talk about that. We also need to increase our presence in their space. But let me just quickly talk about what African Development Bank is doing in this space in terms of providing credit to smallholder farmers. So the first thing is, of course, because we're a big bank and we don't have we don't have the footprint unlike your commercial banks that know the countries that you are. So what we do is that we do lines of credit to commercial banks that actually have the footprint in different countries, and we expect them to on-lend that to small and medium enterprises and small older farmers. Then what we also do is we try to use blended finance to actually bring down the cost of finance to small older farmers, where we actually raise trust funds from donors, and we blend that with our commercial credit so that it brings down the cost of the financing. We have like the 100 million Canadian dollar Agri-Food SME Catalytic Financing Mechanism, ACFM, which is available. This is to provide long-term financing with technical assistance to small and medium-scale enterprises. Let me just quickly, one more minute. We have dedicated instruments that we have also created for women. It is called the Affirmative Finance Action for Women in Africa. I'm sure you are very, very conversant with that. It's called AFAWA. And we have worked with, again, we work with institutions on this because, again, we don't have the footprint. Like we're working with your bank, Zanaco, to develop the Z Women's Banking Program, which offers innovative loan products and insurance to smallholder farmers. Through AFAWA also, we're working with the Exports Trading Group, which has presence in 26 African countries, to actually integrate women into vertically integrated production value chain, from production to consumption. And we also provided about 75% risk guarantee to the Africa Guarantee Fund that guarantees the loans that are given to women and smallholder farmers through their FAWA. The last one, before I write up, just
Bill, how many last ones?
Just the last one. I assure you, just the last one. Is the Technologies for African Agricultural Transformation, TAT. This is where we actually try to look at the effect of climate change and bring heat-tolerant, different types of improved seeds to farmers. We have invested about $60 million in this program across all the African countries, by the way, and we have been able to reach about 13 million farmers with improved seeds that are heat tolerant. So I think I'll stop here before I say one more.
Thank you so much, Robil.
Thank you
so much. It was a loaded question, and thank you for answering it ably. You did touch on high risk. And with high risk comes high reward, and that is the agriculture sector, particularly if you're investing in small-scale farmers. And this leads us to the question that I'm going to pass to Rose. So Rose, how can financial institutions balance risk and reward, especially when they're looking to investing in agriculture, particularly the small-scale farmers? What risk management tools or strategies should financial institutions develop to be able to support this particular client?
Thank you. Welcome, everyone. So I think what is very important is to get a thorough understanding of your agricultural value chain. And it means also that you need to be present in those several parts of the value chain. You need to understand the market dynamics, what's going on. A smallholder farmer will be selling to a processor, a larger trader, who you might finance on your commercial segment as well. So at Rabobank, we have a strategy, international strategy, that is sort of hinges on three key factors. And the first one is sort of our commercial business, or our international wholesale and international rural business, where we finance really large food and agricultural companies, so the mid and downstream players. Apologies. And we have all range of lending products, financial markets products, anything they need. And then secondly, we've got Rabo Partnerships, so this is what I'm a part of. And here we work with strong local financial institutions who have a thorough understanding of their own financial markets. So they might be serving the clients that we cannot reach through our commercial business. We support these financial institutions by taking minority equity stakes. We provide consultancy services. We have blended finance services. And a newer part of what we do is also that we actually develop products and solutions to enable banks to finance smallholder farmers. So this goes as far as credit risk models, loan monitoring tools, all based on more innovative tech and data. Remote sensing data, any type of data you can imagine, that will actually take the collateral issue out of the equation, because you're encouraging them to finance unsecured, because your models at a certain time will be working very well. And then at the end, and finally the third one is our Rabo Foundation, where we serve smallholder farmers, sort of upstream segment, directly through cooperatives, FinAgTechs that are growing and having great solutions. And we've got loans, grants, and consultancy services there as well.
Thank you. That's really interesting to hear what your organization is doing in terms of supporting small-scale farmers. Ndaba, the next question goes to you. And we know that the BII has been doing quite a bit in terms of supporting small-scale farmers. And you recently extended $100 million, which was directed towards trade and food security in Africa. And for Zanaco, you also gave us a line of credit of about $50 million, of which part of that amount goes towards SMEs. and we do have small-scale farmers in that bracket within Zanaco. So what is the BII strategy in reaching the agriculture value chain? And what do you see, what does impact look like for the BII?
Great, thanks Chanda, and good afternoon to you all. This really is an interesting topic for us at BII because food security is at the core of what we are trying to achieve on the continent. The examples you mentioned, Chanda, are very recent, but BII is 75 years old. I mean, we've invested in Africa for that many years. And if I can give some examples going back to the 1950s and 1960s, I'll just give two. Molopo ranges in Botswana. So BII played a key role in the development of the beef industry in Botswana, which is still going strong today. But it was that intervention way back in the 50s and 60s that helped to develop that industry. And so many small farmers have benefited from it because it is a well-established, well-structured industry. So even after we left that company many, many years ago, we have left behind a viable, strong beef industry in Botswana. Another example I can give is Kenya tea development here in Kenya. Again, way back then, BII played a key role in the establishment of that company. And for some of these interventions, it's the small-scale producers, the outgrowers, and so on, who benefit from having a well-structured, well-established offtake arrangement that enables them to sell their produce into a big processor, into a big producer, who can then reach the export markets outside. If I come to our more recent interventions, I mean, the line of credit you mentioned was specifically aimed at supporting the trade in food commodities, in fertilizers, just to make sure that there is a good flow of resources into the agricultural sector in Africa. Zanaco, obviously, we recognize the very important role that you play in the Zambian economy as the largest bank, and so it is a key partner for us in terms of reaching the smaller end of the market. Otherwise, in terms of our investment programs as BII, we do invest directly and we do invest through intermediaries. So examples of direct investments are like the ones I've given, Molapo Ranges, Kenya Tea Development. Recently, ETG is a big platform that we have supported by investing directly, and they in turn support small holders who sell into their chain. We've invested quite a lot of money, for instance, into Indorama, fertilizer producer in Nigeria. Fertilizer is key to the increasing productivity of these small-scale farmers. And so we've intervened directly by investing into that company. Again, going back to Zambia, maybe because I'm from the region, I'm talking more about this. But we also have a direct investment in Zambia called Zambif. We have invested $75 million of equity into that company, again, to promote the development of the agricultural industry in Zambia. A lot of our interventions, though, are through intermediaries, like I've mentioned, through banks like Zanaco, where we provide a line of credit so they can then spread it to the smaller farmers. I think Robel also mentioned that that's a model that the AFDB uses as well. But we also use even smaller vehicles like agri-funds, where they will be able, we can invest a bigger ticket, but then they'll be able to invest that money to support the SMEs and the smaller farmers that we otherwise cannot reach directly. So this is really the broad range of interventions that we do as BII, and the impact is visible because, you know, when you support the farming industries in Africa, they are key to our economies. One other area I might mention is promoting the exports, agricultural exports out of Africa. Last year, we did the first long-term line of credit to a bank in Ethiopia, effectively to help that bank to support producers in the agricultural sector to gear up, improve their methodologies, improve their technology for the export market. And a lot of those coffee producers, for instance, do have smaller farmers that supply into them. And Ethiopia had previously been closed to long-term foreign investment. But when the government of Ethiopia opened up to allow foreign investment into the sector, BII, together with our partners, FMO, were the first to go into the market with a line of credit for agricultural exporters. We've done the same, or we are doing the same in Zimbabwe. Again, a line that is specifically earmarked for agricultural exporters. But as we say, they have outgrower schemes, smaller farmers who come in and support. And in that relationship, we are actually working with Rabo because they are supporting the bank from a technical assistance point of view. And so these partnerships are quite important because we can only achieve so much as on our own. But if we can provide the finance, Rabo comes in with the technical support to the same bank, the overall impact is much greater than if we're doing it on our own. Maybe I'll stop there, Chanda. Thank you.
Thank you, Ndaba, and totally agree with you when it comes to partnerships. As Zanaco, we've also been able to achieve so much because of the partnerships that we have with organizations like the BII, with Rabobank through Rabo Partnerships, as well as the Africa Development Bank. And indeed, the AFAWA project where we've partnered quite a bit to support our female customers. So, Charlie, I would like us to go into innovation and to talk about what innovations Zanaco has come up with, or what innovative solutions and products the bank has come up with in order to support farmers and financial inclusion in Zambia particularly.
Thank you very much. And maybe before I answer that question, I just want to plant a thought in the audience's mind. And it's through a question that I want to ask. How long do you think it should take a baby to learn how to walk? And I'm looking at the mothers, they are smiling. The fathers are probably calculating on their calculators because they think there should be a time span. I think the correct answer should be as long as it takes. The mother would definitely continue supporting the child as long as it takes until it learns how to walk. I thought about that because this is really, really the gist of smallholder farmers and what we need to think about if we have to make meaningful impact. But speaking to your question, how are we leveraging digital solutions? Maybe at the back of that, I can just mention that we've done quite a number of programs in the past, and we learned a lot of lessons out of that. Some of them included the fact that it can be quite expensive to manage a smallholder scheme or solution, because obviously they are a lot and they are dispersed over a bigger space or country. And then it also is difficult to track the good farmers and from the bad farmers, and also create repeat business, sort of models. And we also learned that working with them, it's sometimes difficult to meet their cash needs. They require to use cash. And as a bank, we also learned that we need to position ourselves for the future of smallholder banking, which basically means leveraging on the new technologies. So straight into your question, what we've had to do is to meet the cash needs of these smallholder farmers, we've had to grow our agents banking model, where individuals in the communities that own small stores can do cash in and cash outs for our smallholder farmers. So if someone is planting a crop somewhere, they sell it, they can still access a banking account and be able to deposit money and withdraw. We've also used the partnerships with mobile network operators. They do have a lot of agents, and through that, we also create a cash in and cash out channel. We've also had to do a lot of digital payments and collections so that we can have an expanded reach. And then we've also had to develop a micro-lending system that helps us in as far as assessing credit is concerned. So those are some of the interventions that we've had to do to leverage technology and ensure that we can build scalability, we can drive low-cost models, we can manage some of the inherent risks in value chains, we can create convenience, and we can create impact. In fact, talking about impact, for me, it's the most important variable that an organization should have when they are structuring deals for smallholder farmers. Because if you focus on impact, then profitability follows afterwards. If your focus is on profitability, chances are such that the model won't work. So how can we ensure that the purpose is impact, of course, sustainable models, and then profitability follows? Thank you.
Thank you, Charlie. And impact is very, very critical. And I think that's where partnerships also come to play, because when you partner, you're able to create even more impact, and particularly with fintechs. So still talking about technology, talking about innovation. When fintechs came on the market in Zambia, we were very skeptical, and we looked at them like competition. And we eventually realized that we cannot look at them as competition. They need to be our partners. We need to work with them in order for us to scale and in order for us to achieve impact. In order for us to reach the unbanked, we need to partner with the fintechs. So, Rose, how can fintech solutions be integrated into the agriculture finance systems to improve efficiency and reach and to create the impact that Charlie has spoken to?
Thank you. Yes, so fintechs have done an amazing job in shaking us up, disturbing the sector, and really gave us a wake-up call. The ways that we were serving smallholder farmers, if we were serving them at all, they were inefficient and very expensive. So thank you, fintechs. The thing with fintechs, however, is also that they are often very niche-focused, product-focused, market-focused, and in the recent years also had more trouble getting funding for them to grow and scale. So, and you already answered my question, partnerships is our conviction. So for good service delivery models, you need good partnerships with public sector and private sector partners. And if you want to take it a step further, you can even go towards a platform approach. Whereby all the relevant actors, fintechs, agtechs, and other companies that have relevant solutions, they join together on a platform and offer their services. Banks can approach the platform through a banking as a service approach or even set up their own platform. So why a platform approach? I think firstly because smallholder farmers don't have one challenge, they've got several ones. So if we try to tackle only one, they're probably not that interested because their mind is elsewhere. If we can provide a holistic approach and a holistic solution to more of them, it would be much more strategic and appealing to them. Secondly, is also the unit cost will be much lower, especially on the last mile delivery side. It's still quite expensive, and if you can share these costs with your platform partners, that will be extremely helpful. And this is still not to crack, but I believe also when the right consents are in place, you can share data, which will support you in tailoring your solutions much better and having a much more better value proposition. And then just a little bit about Rabobank. What we do from a platform approach is, so we support local financial institutions with their credit risk models, loan monitoring tools, anything that's sort of in a credit risk perspective for them to enable them to finance smallholder farmers. But then we also work together with a party that offers us a marketplace. So we're also trying to tackle the access to markets issue. So to enable farmers to buy quality inputs, but also have a good network to sell their produce for a fair price. And we use this data on the marketplace for our credit models because it's such relevant data. Then we also work with a crop insurance provider. So when the farmer receives a loan, they're also properly protected when they have a bad season. And gradually we're working on adding more relevant solutions to this sort of ecosystem so we can offer good solutions to smallholder farmers.
Thank you, Rose. I like that you touched on data because with data, we actually get to understand the customers' behaviors. We get to understand the needs and the wants of the small-scale farmers, and we're able to support them even better. And of course, now there's fintechs, insurtechs, agtechs, and we just need to make sure we harness the data that they have collected, because they've managed to collect so much data that I think as financial institutions, whether it's banks or DFIs, we should be able to harness that data. So lastly, I know we're really at the tail end of the panel discussion. Robil, we're coming back to you for a 1-minute response, sir. But I'd like us to now touch on climate change. And I know that the AFDB is doing quite a bit in the climate change space, in the sustainability space, and doing quite a bit in terms of empowering farmers with climate-smart agriculture. So my question is, what is the most promising investment opportunities in Africa's climate-smart agriculture sector that financial institutions should consider, and what is the Africa Development Bank doing in this space? In 1 minute. Thank you.
No, thank you very much. That's also a loaded question. Look, when we think about climate change, we have to think about the issue of food security, water, and energy nexus. Okay? We cannot talk about climate change without looking at what do we do in terms of agriculture, in terms of provision of water to actually sustain that agriculture, but also to engage and actually invest a lot in renewable energy. I think that nexus needs to be taken care of. And that's exactly what the African Development Bank actually does. We are not only looking at just investing. Of course, you have to think about this, but you also have to think about the adaptation and mitigation measures. And then you have to think about, so in terms of investment, you have to do investment in irrigation infrastructure, water harvesting, storage solutions, climate resilient seed systems. I talked about our TAT program, which I think a few years ago, we increased the productivity of wheat in Ethiopia by about 3,000%. And the same thing in Sudan. A few years ago, until the country went into war, by now Sudan should have been self-sufficient in wheat production. Then we have to talk about precision farming techniques, such as remote sensing, satellite imagery, drones for crop monitoring, all those things just to help us make sure that when we talk about food security, we're able to get that. I think the issue of using technology in terms of mobile-based platforms to revolutionize agribusiness in Africa so that farmers can have weather information when necessary, and we're not caught unawares in terms of even issues with prices, market prices, and farming techniques. I think Charlie talked about being an extension agent before. These are the kind of things that we need to actually leverage on. We have to use things like blockchain technology to improve transparency in agricultural supply chains. Of course, we talked about insurance that could actually be tailored towards the smallholders, which is there, but we need to actually deepen that. And more importantly, the issue of renewable energy solutions in terms of solar-powered irrigation, small irrigation pumps to farmers, cold storage innovations, and all that. So these are some of the things. So we have to look at the nexus. We cannot just talk about agriculture without looking about irrigation, water storage, water conservation, and then we talk about renewable to make sure that the whole cycle is actually taken care of. I hope in 1 minute I've answered your question.
Thank you so much, Bill, for indulging us. And it's good to hear what the Africa Development Bank is doing in the space of climate smart agriculture and supporting farmers in that space. Ndaba, last question goes to you. What is the BII doing in the sustainability space, and what difference are you making when it comes to climate smart agriculture?
Thanks, Chanda. I mean, this is such a key area for us. I mean, we are sitting here in Kenya. We've seen what happened with the floods. Coming from Southern Africa, we've seen what's happened with the drought. So climate is really having a big impact in smallholder agriculture. And so we do have to develop solutions that help us to address climate. And so a lot of our lending is directed to a specific purpose. So for instance, we do provide lines of credit that would specifically be focused on agriculture. But in that respect, we could even carve out a portion of the loan to say, look, if you manage to commit a certain proportion of this loan towards climate smart agricultural practices, then we can recognize it through an incentive structure in the interest rate. You can get a rebate. But specifically to promote, the adoption of climate smart practices. But I mean, it's a journey for all of us. People are still learning how to mitigate the impact of climate change. It's even harder to work on adaptation and resilience. But these are all areas that we see as quite important for us to develop so that we can mitigate the impacts of adverse climate change on our farmers. We also look at risk-sharing schemes in some instances, again, just to try and help institutions go into areas which would be too risky for them on their own or unproven. And so by sharing the risk, we are encouraging them to go into those areas which they would otherwise not go into. I think in the interest of time, I'll stop there, Chanda. Thank you.
Thank you so much. And a big thank you to our panelists. A big hand for them, ladies and gentlemen. Indeed, it has been an insightful discussion. And if we had time, we would have gone on for another hour. But I would like to really thank the panelists for taking time to join us here at the Zanaco side meeting. I would also like to thank the Zambia Secretary to the Treasury, Mr. Felix Nkulukusa, who was here to join us, as well as the Deputy Governor Administration at the Central Bank in Zambia, who is here with us as well. So thank you so much to you both. Thank you, ladies and gentlemen, for your time and for joining us. I'm not so sure if we have any questions. Maybe we can take one or two before we close, if that's okay. Okay. I will pass this mic to you.
Thank you. Good afternoon, ladies and gentlemen. My name is Betty Gikonyo. I am a small-scale farmer. And Rabbi, I have a question for you. As a small-scale farmer, how do I plug into your facilities on the ground? Because 2 years ago, your president of the African Development Bank met us at Kempinski, and his team directed us to a certain bank, local bank, that they had given grants for women, for youth. The story goes on. And when we got there, nobody in the bank had an idea as to how we can plug in. So it would be good for us as small-scale farmers. You're here, you can address that access, because yes, some women have a security. They are able to borrow and be able to pay back. And where grants are available, like our gentleman told us, yes, we can also be able to ensure we can pay back. But also when times are hard, how can we access that grant? Because I have used a Rabobank facility in the past to do 23 hospitals in Kenya, and it was a very, very successful program. And perhaps up to now, if there are Kenyans in the room, some of the hospitals that were touched by your facility are the only ones still running and standing, because it was very well structured, implementation, and after you'd left, you still had monitoring and evaluation to find out how is it going. So please, Rabbi, kindly please tell us how to plug in.
Good afternoon, everyone. Good evening, rather. My name is Timlolua Ogunbeko. I work with an investment bank, PAC Capital, from Nigeria. So my question is directed to Daba from BI. So thank you for your enlightening explanation of the various interventions that BII is doing in the agricultural sector. So my first question is, so does the BII fund every stage of the value chain, of the agricultural value chain? Also, is it just equity funding or both equity and debt funding? I would also like to know, in terms of ticket size for the funding, what is the minimal ticket size you would fund, or the minimal project size you would look at typically? And is there a maximum cap you would do for any agricultural project? Also, I would like to also know, in terms of collateral security or KYC onboarding, like how do we package, as investment bankers, we deal with advising our clients and helping them package their business and projects in a way that it becomes bankable. So in terms of your KYC, security, collateral, how do we plug into this? How do we, I would just like to know more about that. Thank you.
Good afternoon to the panelists. Thank you for the interesting discussion. My question is to anyone in the panel. I think with agriculture, one of the biggest things that remains a challenge for small-scale farmers is the cost of finance. In spite of the number of facilities, so banks have facilities, especially some of the facilities that are like government money, public money, or from MDBs, or facilities that are channeled through commercial banks for onward lending. We still don't get to see farmers benefiting from the low cost of that. So what can you do as the respective different financial institutions to really pass on that public good to farmers cheaply? For example, one example is you spoke about data, about use of data. A lot of this data is generated from farmers themselves, right? You survey the farmers, and yet when you make products from the data, we don't see the benefit of improved technology being passed on in form of lower cost of credit. And insurance, another thing, I think I'm happy you mentioned insurance, especially now with climate change. The volatility in the agriculture sector is that farmers cannot afford to have credit which is short-term. They need long-term credit that helps them get through the cycles when they're not doing well. So I think those are some of the most beneficial things that can really get farmers to move up the value chain, and not this sort of short-term, speculative kind of products.
Thank you so much for those questions. The first question will go to Robil, and the next one, Ndaba, that was for the BII. And the last question, I'll ask both the commercial banks on the panel to give a brief response.
Well, thank you very much, Chanda, and thanks, Madam. So let's first try to understand something. So African Development Bank, the way we operate, our principle is that we don't want to distort the market. Actually, we will rather not do something that we know that we're not actually making any addition to. If a commercial bank can do something, or any of our collaborators or our partners can do something, if there's no additionality or complementarity, then we don't want to get into that, because that's not the purpose. You have to understand the development space is so huge, and we have so little resources. So we have to collaborate and also look at things that we don't really have to get into. But having said that, SMEs particularly is very, very dear to the bank. And I just talked about 2 interventions that we had for SMEs, like the TAT program, the AFAWA. There's so many of them. We could sit down here for the next one day talking about our interventions in that. But also, you have to also understand that we are a bank, a development bank that is, we're not, even though we are present in countries, we're not as present in countries. For example, we have a regional office here in Nairobi, which covers all the countries in the eastern region. But when you talk about Kenya, the number of staff that actually covers Kenya are probably, I don't know, depending on the sector. You understand what I'm saying? So then, I don't know what's the biggest commercial bank here. They probably have, the footprint is huge. So we cannot be advancing credit to yourselves, the SMEs here, when we don't have the footprint to monitor what you are doing and all that. So that's why we do LOCs, we do risk guarantees. We have a lot of other tools that we use. So what I'm going to suggest is that now it's very possible because, again, the commercial banks' money is fungible. I cannot say they cannot do that. We give them, just like Ndaba was saying, we give them lines of credit. Specifically, they give us the pipelines, showing us that these are the SMEs that they want to do, and we extend the lines of credit to them. Okay, go on and lend to them and all that. And of course, some of them, even like Zanaco, we provide technical assistance just for them to be able to attend to women specifically through their FOA program and all that. So all those things are ongoing, but I cannot say that what you're saying is not the truth. What I will do is that I'll give you my contact and I will link you up with our colleagues there that are in charge of the region and specifically in charge of Kenya, and you speak with them and then we'll take it from there.
Thank you, Robil. Just to remind the panelists that we are actually out of time, so we need to be very quick with our responses. There's another panel coming in after us. Ndaba, the question on BII.
Yeah, I'll be very quick. I think as indicated, we intervene at various levels. We do have very large funding into big companies, and then we have funding into banks and financial intermediaries who can then reach the smaller end of the market. And so for us as BII, we want to be supporting every aspect of the value chain. As I indicated, we're even financing fertilizer producers. So inputs into the agricultural sector, people who do the actual production, as well as the marketing and access to export markets. So we are across the value chain. But in terms of direct intervention, our ticket sizes are quite big. So minimums would be $10, $15 million. Those we can do directly, but anything below that, we then work through our partners. Thank you.
Thank you for that. The very last question, very briefly, Charlie and Rose.
Okay, I can go first. And I think Xavier has mentioned some of the variables that need or should be used in order for pricing to smallholder farmers to go down. So we've been trying to use guarantees. Of course, the use of technology is another one. Blended finance that Rosie spoke about is another one. Back home, we've tested the possibility of reducing interest rates when we supported the Sustainable Agricultural Finance Facility. I know that we've got DGO here, and I know that the central bank has certain interventions that make it not possible to do certain things, but I'm sure DGO is much aware of the things that they'll probably need to do as well to help us from a liquidity in the market. I know that they're trying to drive certain variables to work well, but also the impact that has on the pricing. So these are some of the variables that we can use, and I totally agree with you that we need to start passing on that benefit to the smallholder farmers. Thank you.
Thank you. Rose?
Yes, to add to that, so why are these rates so high? It's your operational cost, so your cost to serve is high, and your risk, your perceived risk is high. So how can we tackle those two issues? Is to through tech and data. So to have credit risk models that use also alternative data, remote sensing, transaction data. We look much more at the farmer demographic data. And but as Charlie mentioned, a child needs to learn to walk, and these models also need to learn how to walk. So it takes time. And in this meantime, you need blended finance facilities, crop insurance, etc., for the banks to be confident to move forward with these type of new tech solutions. And it's also behavioral change, because banks are very used to using collateral. This is not always available, especially not with smaller farmers and especially not with women farmers. So we need to look at unsecured loan possibilities, and I think these tech solutions are really the solution.
Thank you so much, ladies and gentlemen. That's all the time we had. We've actually exceeded when it comes to time. But I'll ask the panelists to just stand so that we can take a picture. Before we leave the stage, I will ask DGO and ST to kindly join us for this photo opportunity before we leave the stage. Another big hand to the panel, ladies and gentlemen.
What's your minimum ticket size? 50. Okay, give me 30 just to... Oh, right, okay. So Is it okay like this or I shall keep it flat? Okay like this, because now it's easier for me to. No, we are for the next one.
It's a beautiful place for memory. So much. 1 minute late. Do just 1 minute. Yeah, okay. Just 1 minute. I'm short, maybe. Yeah. And another one.
Good evening, ladies and gentlemen. So we will start in five minutes. Thank you. So you can please take a seat, get comfortable, and we start soon.
Okay, good evening, everyone. Good evening, ladies and gentlemen. It is my immense pleasure to welcome you, each and every one of you here with us physically, and those who have joined us online, to welcome you to this event, which promises to be an interesting discussion that focuses on the pathways to enhancing financial inclusion and economic empowerment, leveraging fintech. I am Elizabeth Waifo. I'm the managing partner of Radix Legal and Consulting Limited. I have over 35 years experience providing legal advisory and business consulting services to my clients that include banks and corporations. I have a special expertise in structuring and documenting finance transactions and a track record in helping clients find customized solutions to their unique needs. The firm Radix Legal and Consulting, which is your host today, is a firm of lawyers and consultants. We offer more than legal services, and we provide legal support as well as help clients build businesses. Our clients include fintech companies, development banks, microfinance institutions, and commercial banks and regulators. Our intention in this conference is to contribute to the development and growth of our clients' businesses by bringing together institutions and businesses that are complementary and have a potential for exponential growth when they collaborate and work more together. There's an African saying that demonstrates what our intention is about. And the saying goes like this: alone, a youth runs fast. With an elder, slow. But together, they go far. We want to work together. This conference is about bringing together the various facets of financial industry that will help us deepen financial inclusion and result in sustainable economic development as well as prosperity for the continent of Africa. I want to share with you my delight at having the opportunity as well to shine the light on the role being played by our young people and women in building the Africa of our dreams. On our panel today, you are going to find that we have some really dynamic speakers. We've got amazing young people, and they will include, you will see a lady called Fanta Toure, who is under 30 and is the CEO of the only private locally owned microfinance institution in Côte d'Ivoire that is doing amazing things. We also have Agnes Muthoni, who is one of the leaders of Tala, a fintech company that is making great strides in driving financial inclusion here in Kenya. We've got Karijatu Najiru, who has a track record of building businesses, both physical products and digital products. We've also got Miriam Karius, an English, French, and Côte d'Ivoire lawyer who is providing legal and business building support in Anglophone and Francophone Africa. So these are women doing amazing things and also very young people doing amazing things. But in addition to that, we also have the support of the men. We have, yes, we've got Jeremiah Danokai of the Development Bank of Nigeria, who has a track record of supporting women in achieving laudable business objectives. And we also have our keynote speaker, Mr. David Atut, Mr. Ahmed Atut, who is the acting director for here at the African Development Bank in the financial institutions sector development. So these are all people who in their own different ways support women, support the youth, support Africans generally in wanting to achieve financial inclusion and economic empowerment. And I trust that you are going to have an enjoyable session. This brings me to the end of my opening remarks. I trust that you will enjoy the conference. Thank you. So I will now proceed to introduce our keynote speaker for the evening. Our keynote speaker As I mentioned, is Mr. Ahmed Atut. He's the acting director, and here I will get of the Financial Sector Development Department of the African Development Bank. He has more than 24 years of working experience in Africa and the MENA regions, and has led the delivery of transactions in excess of $5 billion US spread across over 30 African countries. He has extensive experience working with private sector institutions, understands the needs of microfinance institutions, and is passionate about achieving the African Development Bank's objectives for financial inclusion. Unfortunately, Mr. Atut cannot be physically present with us today because a short while ago, he was called out to a meeting of ministers and has therefore asked someone else to replace him in delivering his speech. And we're very lucky that his replacement happens to be the Chief Financial Sector Strategy Officer in the Financial Sector Development Department of the African Development Bank. We're very lucky to have Mr. David Ashiagbo represent our keynote speaker because his experience is very much in line with what we are talking about today. He was the head of the Making Finance Work for Africa initiative of the African Development Bank between 2015 and July 2020. He has over 20 years experience in the African financial sector in areas including SME finance and capital markets. He has previously managed the Commonwealth Private Investment Initiative, which raised over $800 million US for investment in Africa and other areas. And he has also worked with the International Finance Corporation. David is a graduate of the London School of Economics and the Management School at the Imperial College London. It's an honor to have David to represent Mr. Atut at this event. So please join me in welcoming Mr. David Ashiagbo.
Thank you, Elizabeth, for that introduction. It's not very often that I hear people speak about me in such flattering terms. So I'm feeling very proud of myself tonight. I think the first thing I must do is to apologize on behalf of my director, Ahmed Atut, who was really looking forward to being here, but unfortunately, when we come to the annual meetings, our directors are not masters of their own destinies. So he was called to a meeting at the last minute and has asked me to represent him. So, distinguished guests, ladies and gentlemen, let me begin by thanking Radix Legal and Consulting for organizing this important event and for the opportunity to speak on financial inclusion and the role of fintechs in digital financial transformation in Africa. This theme resonates particularly well with the imperatives of the times as the African fintech ecosystem grapples with the need to adapt to a fast-changing landscape characterized by volatility and uncertainties in the global and national economies, including macroeconomic instability, rapid currency depreciation, and rising inflation. The need to leverage technology to support Africa's transformation and build resilient and inclusive economies has never been more urgent. Technological advances over the last decade and a half continue to transform Africa and the world at large. Perhaps the most visible and transformational impact of technology on our continent has been in financial services and financial inclusion in particular. A 2023 GSMA report estimated that the continent now accounts for over 50% of the 1.6 billion globally registered mobile money accounts and 74% of the $65 billion in global mobile money transactions. The impact of African fintech extends well beyond banking and payments for the underserved populations. Since the launch of M-Pesa mobile money here in Kenya in 2007, the range of available digital financial solutions in Africa has expanded significantly to include digital wallets and payment platforms, loans, savings, insurance, and investment solutions. Beyond that, from health tech solutions, ensuring that healthcare is just a click away, agri-tech platforms connecting farmers to markets, weather forecasts, market prices, and financing solutions, to edutech, helping to ensure accessibility and affordability of educational services for parents. Technological innovations are driving economic and social inclusion and providing locally grown solutions to African problems. The African fintech ecosystem's capacity to innovate has attracted global investor interest, with 26 reported fintech acquisitions in Africa between June 2021 and July 2022, and 63% of tech funding in Africa, which is about $2.7 billion US dollars, going to the fintech sector. This strong momentum is also evident in the emergence of several unicorns, which, as you may know, are startups with a valuation of over $1 billion, including Wave, Flutterwave, Interswitch, and Fowry in the African digital financial services sector. Ladies and gentlemen, we at the African Development Bank strongly believe that a resilient, innovative, and diversified fintech sector is key to accelerating economic transformation and inclusive growth in Africa. In the words of our president, Dr. Akinwumi Adesina, with the right investments in innovation and smart digital growth, the obstacles to achieving financial inclusion and greater economic opportunity for all will be overcome. This is why leveraging technology to expand access to and usage of financial services is at the heart of the bank's financial sector operations. Financial inclusion is embedded in our operations and cuts across various sectors, including agriculture, energy, industrialization, youth, gender, and of course, MSMEs. Our financial inclusion work is built on 4 pillars. First is infrastructure. We invest in national and regional interoperable payment systems in line with the bank's regional integration agenda and support the deployment of agent banking and merchant networks. Examples of this include the Digital Financial Services Interoperability Project in the WAIMU zone, that is the West African Economic and Monetary Union, so basically Francophone West Africa, at a total cost of $11.4 million US dollars. This project aims to ensure interoperability of all financial services, regardless of the type of account. So wallet to wallet, wallet to bank, and bank to wallet. We also have the modernization of payment systems in 4 countries in the West African Monetary Zone: Guinea, Gambia, Liberia, and Sierra Leone. At an overall cost of $23 million, this project aims to upgrade the payment systems of beneficiary countries with a view to developing intra-regional trade. So basically, the idea is upgrade the payment system so that payments can flow, cross-border payments can flow more easily, cheaper, and therefore promote intra-regional trade. In terms of policy and regulation, we work with central banks, telecom regulators, and others to improve the policy and regulatory environment as an enabler for responsible financial inclusion in Africa, with the emphasis on responsible, with the emphasis on a strong emphasis on responsible, and with a focus on enabling innovation through new players and approaches, reducing costs and enhancing competition, whilst safeguarding the stability of the financial system, maintaining its integrity, and importantly, protecting consumers. The Tunisia e-government project, for example, aims to improve public services offered to users and strengthen the performance, openness, and quality of the Tunisian administration at an overall cost of 170, I was actually going to say $170, but it's 170 million. It's 170 million US dollars. Ecosystem players, products, and applications. And I think this is probably where the bulk of the work is in terms of number of interventions. So we work to catalyze a wider use of financial products and services by supporting innovative project designs which respond to the needs of the underserved. And so by the underserved, we don't just mean people who don't have a bank account, we mean anybody who cannot find the type of financial services that they need to be able to organize their financial lives. So interventions here will include support to develop products for underserved market segments, including, for example, savings and loans, input financing, equity capital, insurance, village savings, crowdfunding, payment products, and of course, looking within that at underserved populations, some of which were cited before, women, youth is becoming an increasingly important cluster for us. We've had some success on the gender front, so looking to kind of replicate that on the youth front. Obviously, also micro, small, and medium enterprises, but within that scheme of things, also looking at the corporates, because even the corporates are underserved by our financial markets today. So we also support financial services in real sector value chains with a focus on the high fives. I hope you all know what the high fives are. Light Up and Power Africa, so Light Up and Power Africa is really all about energy with a focus on strong emphasis on renewables. Feed Africa, agriculture, agribusiness, agri-tech, strong emphasis again on climate smart agriculture. Industrialize Africa, which is all about, manufacturing, growing our industries. Integrate Africa. Integrate Africa is really all about trade and sort of building a regional financial integration, so regional payment systems, that kind of thing in this context. And then the last one is improve the quality of the lives of the people of Africa, which is where you get all the investments in the social sectors, education, health, financial inclusion, and actually anything that goes to improve people's lives. So supporting financial sector value chains with a focus on the high fives, supporting product development with a view to reducing costs, improving agent and merchant network approaches, which I think I've mentioned before. And I think importantly in the context of the discussion that will follow, supporting fintechs to develop new products and solutions. For example, tech-driven credit scoring and lending, which has direct links to improving access to finance for the underserved, be they individuals, be they home-owned businesses, be they formal MSMEs. Another example is using big data to support agribusiness value chains. So looking at things like weather-based index insurance through mobiles. I know through ADFI, which I'll talk about in a minute, we are supporting some insurtech companies to develop ag insurance products specifically directed at women. So we also support entrepreneurship ecosystems, so including incubators and accelerators, to develop models, sustainable models to assist MSME startups with digital and tech solutions. So a few examples here. We've done digitization of government payments in the Manu River countries, which are Guinea, Liberia, Sierra Leone, at a cost of 2.8 million. This project puts in place an ecosystem conducive to mass payments with a particular focus on the digitization of government to citizen and citizen to government payments with a view to digital financial inclusion. And of course, the corollary of that is that you're bringing people into the formal system. You're reducing, I think the politically correct term to use is leakages. Yeah. And we've also supported the digitalization of agricultural value chain finance in Cameroon, DRC, and Gabon. So here, this was a project of €1 million in partnership with Advance Group. For those of you who may not know them, Advance is one of the leading microfinance groups in, I think they're mainly in Francophone Africa, but I think they're also in some countries in Anglophone Africa. Anyway, this project aims to digitize agricultural value chains and support the development of customer-centric products through innovative distribution networks. Partnerships are obviously a big part of what we do at the African Development Bank. And in fact, partnerships are very much in our DNA. And what many people don't know is, for example, we don't actually finance more than 25% of any project. So essentially, we cannot do a project without partnerships, right? And we also have strong partnerships in that allow us to support some of the work in this area. I'll speak very quickly about this when I see that I've got less than 2 minutes, which is fine. Partnerships. So we have ADFI, the Africa Digital Financial Inclusion Facility, which is a partnership between the bank, the Gates Foundation, Agence Française de Développement, the French and Luxembourg governments, Women Entrepreneurs Finance Initiative, WIFI, and more recently, the government of India. What does ADFI do? ADFI supports catalytic investments in digital payments infrastructure, policy and regulatory development, and the design of innovative products and services for both the public and private sectors. Through ADFI, the bank is investing in projects to help African countries close the financial inclusion gap. This includes support for digital payments infrastructure that aims to promote interoperability and, in tandem, regional integration. So some of the projects that I spoke about a minute ago, and cross-border trade. Examples include investment in the national payments infrastructure in Ethiopia alongside the Gates Foundation, and technical assistance towards the harmonization of the payments and settlement systems in ECOWAS. In West Africa, ADFI is doing work on gender mainstreaming and digital financial services, policies, and regulation. Another partnership we have in this area is with the European Investment Bank. It's a program called Boost Africa, launched in 2016 to support venture capital fund managers and entrepreneurs to address the obstacles faced by startups in the ICT, agribusiness, financial, health, education, and renewable energy sectors. The bank has to date approved 28 million under the Boost Africa program for fund managers with a Pan-African focus. So distinguished guests, in closing, let me highlight 3 key messages. First is that the need to leverage technology to support Africa's transformation and build resilient and inclusive economies has never been more urgent. too. While we celebrate progress in the fintech space, challenges persist, including in the regulatory environment, which needs to keep abreast of technological advances whilst providing space for innovation and disruption, all whilst safeguarding the integrity and stability of the financial systems. Finally, we at the African Development Bank strongly believe that a resilient, innovative, and diversified fintech sector is key to accelerating economic transformation and inclusive growth in Africa. This is why leveraging technology to expand access to and usage of financial services is at the heart of the bank's financial sector operations, as I hope I have been able to demonstrate in these few minutes. I wish you all an engaging, purposeful, and successful continuation of the African Development Bank Group's annual meetings. Thank you very much.
Please join me in giving another round of applause to Ms. David. Thank you. Okay, I'll now hand over to our moderator. And our moderator this evening is Ms. Karijatu Najiru.
Good evening, ladies and gentlemen. I'm glad to welcome you to this panel discussion that's going to be focusing on unlocking financial inclusion with a specific focus on fintech and microfinancial services in Africa. Please allow me to introduce our panel this evening, consisting of various people that have already been introduced. I'll start off with asking Agnes Muthoni to come to the stage. Agnes Muthoni is coming from Tala. Then I'll proceed with asking Miriam Karias to come to the stage. Miriam is running Karias and Partners. I also ask Jeremy Danokai from the Development Bank of Nigeria to come on stage. And I'm also going to ask Fanta Torre from the Savings Bank for Individual Development in Cote d'Ivoire to come on stage. Before we get started, I just ask the tech team to provide us with a second microphone. All right, so we're good to get started. I'll start off this panel discussion with a few housekeeping rules that will include all of us at least leaving our phones on silent to allow for our panel to be able to communicate clearly and avoid disruptions. But I'll also start off by highlighting what the objective of this panel is. The objective of this panel really is threefold: to really understand what is at the backbone of financial inclusion, but also highlight the areas of possible value creation between existing microfinance institutions and fintechs on the continent of Africa. So I'll start off the discussion with Jeremy. Jeremy, let's talk about SMEs in Africa and how we regard them as the backbone of African economies. SMEs in Africa are quite many, holding close to 90% of them across various African countries, but primarily these SMEs are contributing quite a lot, of up to 40% of GDP. Let's talk about your role at the Development Bank of Nigeria. How has the Development Bank of Nigeria really been able to harness SMEs and MSMEs in Nigeria? What work have you done? And primarily, we would also like to really shine a spotlight on some of the operational strategies the Development Bank of Nigeria has put in place to be able to get to certain milestones.
Thank you, Karijatu. I think that's a lot of questions packed into one, so I'll try to do justice to it. Thank you again, Elizabeth, for the platform and opportunity for us to share our thoughts. So I'm going to do two things. One is try and paint a picture of the financial inclusion landscape in Nigeria, focusing on MSMEs. And then I'll overlay that with what we're doing as DBN, or some of the strategies that we've sort of leveraged to drive financial inclusion. So the first thing I would say is, why should you care about SMEs? And in answering that question, I want to look at it from a micro and a macro point of view. From a micro point of view, I think it's a muted point. Entrepreneurship is an alternate economic lever for all of us. So it's either when you leave school and young people leave school, it's either they go get a job or they create jobs, right, through creating their own business. So that's entrepreneurship. So I think it goes without saying that it's important as a source of livelihood. That's at the micro level. But at the macro level, which is where I'm going to spend some time to sort of explain why it's so critical, and that's the point Karijatu was mentioning. Why should we as a country or a nation or as a continent, Africa, care about SMEs? Now, she's already started to make certain important data points that is key. One is the contribution to economic growth, in which we benchmark with GDP, right? And if I look at the Nigerian case study, SMEs in the country are 90% of all businesses in the country. And they contribute more than 50% to our GDP, right? They employ more than 80% of the workforce, right? And when you talk about economic diversification, they are cut across all sectors. Now, then you ask yourself, if this economic actor called MSMEs contribute 50% to GDP and employ 80% of your labor force, so any serious country should pay attention to it. And in looking at it from that perspective, you then realize that it is important that when you look at the factors of production, and I just isolate the point of capital being one of the factors of production, this economic actor called SMEs in Nigeria, less than 10% of the private sector funds, financing flows in Nigeria, less than 10% goes to SMEs. Then the question is, so how do you expect them to survive? Now, statistics have shown that a lot of them are using savings or they're using monies from family and friends. So there is a capital issue with respect to mainstreaming that towards this SME space. So that magic number is 10. So if you're thinking about an institution that will come and focus in this space, you're thinking about how do I get this contribution from 10% upwards? And I'll tell you why it's important. We did a study with the World Bank towards the end of last year. And when we did the study, we were trying to map the financing gap in SMEs. And so we looked at the supply side and demand side. It was so shocking that the total amount of funding required for SMEs in Nigeria is about 13 trillion naira. And when we looked at it and juxtaposed that against the demand, the demand is about 13 trillion. The supply was about 1.4 trillion. So we currently have an existing funding gap of 11.4, so 1.6 trillion, so 11.4 trillion. So today, 11.4 trillion is required. This is at 2022, so every year is increasing, right? Then you ask yourself, how much money do we have to raise as an institution to close the funding gap? So here is where the problem is. If you look at my entire balance sheet as Development Bank of Nigeria and put all of our balance sheets as development finance in the country, we don't get to 5 trillion. So even as development finance, we can't close the gap. So what should you do? And when you think about the intervention DBN is playing in the space, you have to say to actually play a role where you can really catalyze finance to SMEs, you have to play a catalytic role. Why do I say that? You have to get your balance sheet is not enough. How do you leverage private sector, right? And then we did a statistics one of the years, and we realized that 10 trillion of the bank's money was sitting in treasury bills. Treasury bills is one of the bankers won't like to hear it, but it's one of the lazy ways of banking. So you just take money and you put it in risk-free investment, and you make money. You're not doing financial intermediation. So you said to yourself, if 10 trillion sits in treasury bills, how can I, and the science and the wisdom is, how do I begin to encourage, incentivize these guys to move the money from treasury and move it into the real sector? So if I do that incentivization, if I play that catalytic role, and then I also add my balance sheet, maybe I'm closer to closing the funding gap. So what Development Bank of Nigeria was set up to do was to play that catalytic role, to say, I will provide capital where required to MSMEs, but I wouldn't just provide it directly. I will work with the banks, what we call participating financial institution, to incentivize them to also use their money to lend to SMEs. So the question is, how will you do that? Two ways. We're going to, that there's a perception of risk in funding SMEs. So we're going to do what we call risk sharing. So we have a risk sharing product where if we tell the banks, look, we can take up to 60% of your risk should you lend to this space. So that's an incentive. The second thing we do is the capacity technical assistance. And we've realized that the banks in themselves, one of the reasons why they don't also fall apart from the risk is that they don't know their model today, in the banking model today is not necessarily SME friendly, it's collateral based. You can do that for retail, collateral based. You can do that for corporate, collateral based. But you can't do that for SME. You're telling a young man who is waking up one morning and says he has a vision to be a tailor, and all he has is his passion and his skill of tailoring, and you tell him to bring a collateral. Where will he get it from? Right? So if you're saying I will lend on collateral, that guy is already excluded. So, but there are other models that you can use to lend. And so what we did in our technical assistance to the banks is to teach them the new models of lending to banks that you can lend on cash flow basis. And so far we've had like 5 banks, 6 banks who have created new cash flow lending product that is not collateral driven. And that is the critical impact. So far we've lent about 787 billion naira to an impacted over 495,000 SMEs in the country. We've created 1.2 million jobs in the process. And if you look at that number of SMEs that have been impacted, 72% of them are women, 27% of them are youths. And this is by creating access to capital, by doing risk sharing, like I said, and by creating that technical assistance. And the other part we do is also capacity building to the SMEs, because we also need to ensure that the SMEs themselves are fund ready. How do you create structures? How do you keep your books? How do you ensure that you have the right, skills and make yourself, fund ready? And those are the things we're doing as a bank, and we're creating the impacts that we're creating so far. Thank you.
It's really interesting that you've spoken about this huge financing gap. And just for our audience, this panel represents various markets across Africa. So the 11.4 trillion figure he gave is in Naira. I don't want us to think that it's in USD. So I'll just ask my panel to really reiterate when you are using specific market currency. And so you spoke about leveraging the private sector, specifically when it came down to the risk sharing and the knowledge transfer you've done for some of the financial institutions. I want to flip this conversation and go over to Fanta, specifically with regards to how you have this huge mission of reaching 4,000 women, 2,000 youth, and 1,000 SMEs by 2024. Now, Fanta's organization is one of 2 Ivorian-owned microfinance institutions in Cote d'Ivoire. And so we would like to basically hear from you in terms of your business operations. What has the journey been like getting your business to be more digital? What does a digital transformation journey look like?
Thank you, Karijatu, for your question. I'm very glad for this question because we know we live in a digital world. We know that you cannot be manual while living in a digital world. So you usually think, okay, I have a plan to be digital. Here's how I'm gonna do it, step 1, 2, 3. I'm just gonna copy and paste it and it's gonna be great. If only it worked like that. We've learned, I would say, the hard way that being digital is not just, implementing like the software and the hardware. It goes well beyond that. We knew it was important to be digital because it will allow us to be more effective in treating the operations for our customers, being more effective into the application of our mission, which is to provide financial service to all Ivorians, despite no matter their social and economic status. That was the easy part. We know we wanted to do that. How we're going to do that was to streamline our whole process, our whole operational process, from how the clients were to create their accounts to doing deposits while they were at home, to be able to request loans while they were still in the office without ever having to be present within our locations. That we knew we wanted to do. Partnering with different fintechs like Wave, as you mentioned before, to be able to transfer your funds from a fintech, a digital wallet, to your actual bank account. Because we knew having those options will make a world of difference to our targets, which are women, the youth, SMEs, people in the agricultural sector, because we know they generate a lot of revenue. They're the driving force of economies, which are often forgotten because they do not usually fit the profile. They don't have the time to leave their business because to them, any minute is actual money, because the time they take away from their business to come to me is the time they could have served the customer to make more money. So once we knew that, we bought a software. We're like, oh, this is great. It's gonna help us with our internal controls. It's gonna help us disperse loans a lot faster. Everybody's gonna be happy. Our customer's gonna be happy and everything. We bought it, we implemented it, and the day we implemented it in our main our headquarters is also the day the rest of our locations shut down all across the country. And we're like, it's only been an hour. What is going on? I thought we did a good job. I thought everyone was gonna be happy, but it's literally within the hour, I was getting called, like, hey, like, what's going on? We have no service. The customers are in front of us. We cannot fulfill their operations. What's going on? What do we do? From that, it took us a week to fix it, which was a huge blow to our operations. We took a step back and realized that there's main obstacles, huge obstacles that we did not counter for. It's the fact, one, our infrastructure. A lot of infrastructure, of digital infrastructure, are not well equipped to handle modern day digital solutions. We had this top-notch software that multiple banks used, multiple financial institutions used. We thought everybody used it. What's the issue? It should be easy. But we were not equipped to handle such innovation. So we realized that not only we had to redo our infrastructure. I was like, what is an infrastructure? I don't know that. I know about finance. I don't know that much technical term. We had to change everything. And then we also realized there's something about internet. You cannot bring a web-based solution somewhere that has no internet. You cannot have bring a super developed web-based innovation system somewhere that does not have reliable power. If you do, you'll have the same issue as us. No one will be able to use it. And that defeats the whole purpose of having new innovation implemented in the system. Once we realized our hurdles, we were like, okay, there's one more thing that we hadn't accounted for, because we did our digital plan, we sat in our own offices, we were like, okay, this is what the people want. This is what we know what they want. But we don't realize we have the privilege to not really know the realities. So what we did, we hit the ground running. We went to the people. We did the countrywide survey. We asked them, how long do they know us? How long have they been with us? What do they want? What do we do that they like? What do we do they don't like? And what do they wish we had? From that, we realized that everything we thought we were giving them as solutions, they did not care for. Because what do you mean I'm giving you a loan to buy a new company, but you're trying to figure out how you're gonna raise your expectation, how you're gonna buy more stock to resell it at this. We did not do what they wanted to. We did not provide the services they actually wanted. So with that, we took our learnings from the failed implementation of the system. We took the learnings from what the people told us. We changed completely our politics, loan financing policies. We changed completely our digital planning, and then we looked for solutions. Okay, there's no stable internet. Well, there's satellite internet that can be installed in any location, no matter how rural, no matter how far it can be. There's a great thing called the cloud. Okay, in the cloud, there's no power outage. And once you have these two, you can have web-based solutions. When it comes to having the people not have to travel far to come to our locations or not having to leave their businesses to be financed by us, there comes again the fintechs, but we went a little further. We have plans to create more products with QR codes to help them be able to deposit money using fintechs like Wave, so that they can even be more, they can even have more access to financial services without having to leave their respective place of business, because that's what they do. They do business, and they do it in the purest form of business. You don't have to be a large corporate or like a well-established place for you to be considered a place of business. And that's why it was so important for us to learn from them so that we can better serve them. We're not done with our journey. We're still far from being done, but we've learned a lot, which has allowed for this journey to be painful, very painful, but also very beautiful. And it has made a world of difference on how we'll operate in the future to come.
Thank you for that. I think Fanta's journey in digitization really highlights the expectation versus reality of deploying digital platforms and digitizing manual processes in Africa. She's clearly highlighted that it's not just an issue of operational expenses, but it also boils down to something really important, and that's the infrastructure gap, which is why I'd like to bring the conversation to Agnes. Let's talk about Tala. Tala is in the business of alternative credit scoring, so I'd like you to talk a bit about that. And let's also talk about how it's enabling access to financing across Africa.
Thank you very much, Karijato. It's really been interesting just to hear what Jeremiah has had to say and also what Fanta has had to say. Let me talk about Tala and why we exist today. So when we first started, we started with the idea of how can we be able to solve a fundamental problem that existed 10 years ago and still exists today. That fundamental problem is trust. Trust is in regards to when you think about the customers that we serve today. These are customers who are unbanked. Many of them do not currently have financial records. They do not have a banking history. And so the question then became, how do we establish trust to be able to determine whether we can extend a loan to these individuals? And that's when our founder came up with this idea of, what if we could use alternative data to be able to credit score these individuals? What that means then is, today, the way in which our product exists is a customer can proceed to download our app using their Android phone, and through that we can be able to access multiple different sets of data that helps us to get a better sense of, one, their capability to pay us back, and two, to some extent, their willingness to pay us back. One of the things we say is that we'd like to think of ourselves as a data science company, because if you look at the customers today that we serve, most people, if you give them a loan today, they will take that loan. But where it becomes really, really important to pay attention to is how to clearly determine whether they will pay back that loan. And so what we've been able to do is we've been able to use alternative scoring mechanisms to be able to extend credit to the underserved and the unbanked. And today, we've been able to extend credit to more than 4 million people, and we've been able to disburse over $2 billion here in Kenya. So that's just a testament of what we've been able to do during this period. Our repayment rate, we're proud to say, has remained at 95%.
I think Tala's journey really emphasizes how fintech and digital transformation can accelerate reach and scale. I'd like to stay with you, Agnes, and basically give us a rundown of your experience in microfinance and fintech. What are some of the biggest challenges in relation to expanding across Africa? As you know, business in Africa is naturally tough, but it can be a mammoth task to expand across different geographies for any fintech. Just highlight on that briefly.
Wow, yes. So, You're right. So I used to actually work for a microfinance organization called Etseho. When I started out, they were essentially providing only one product, which is a payroll lending product. When I came in at that particular time, they were looking to expand across multiple markets in Africa, together with also diversify their product offerings and also become like a digital first, financial player in Africa. Some of the problems that we experienced at that particular time were very similar to some of the things that have already been shared by Jeremiah and Fanta, which were, number one, at that particular time, what we were experiencing was we were extending loans using collateral. And we needed, first of all, to go through that digital transformation, which is a journey. It's not something that you can just flip the switch and turn on. It takes time. It takes, one, understanding the markets that you operate in. It takes time to understand what are the gaps. For example, do those markets have internet access? Or do they have power? What is our reach? So those are some of the things in terms of looking at from a digital transformation perspective. We needed, first of all, to understand what markets were ready for us to be able to go in and deploy some of the digital products that we were looking to deploy. The second thing is regulation. The regulatory framework, depending on what markets you're looking to expand into, can differ from country to country. And it takes time to review the regulatory requirements and to understand whether you can be able to meet those requirements or not. So you can imagine the heavy lifting that's required to proceed to acquire all of the licenses that are required across multiple markets. So in some cases, what we decided to do was either go through acquisition. So for example, in Nigeria, we acquired a microfinance, which enabled us to immediately get the licenses that we needed to run our businesses there. In other markets, we proceeded to, go through the actual exercise of, securing the banking license. Other challenges that exist, again, is understanding your market, really. Understanding the segments that you want to serve. Understanding also, the fundamental problem also is, going back to identification. How can we be able to identify these individuals? What sort of, do they have a national ID that's in place? What sort of unique identifier can we use to be able to identify these individuals? That's a really important aspect. And then the other aspect that I would touch on is also the infrastructure around payment trails. This is a few years ago, we did not have, companies like Flutterwave. Now we do. We have companies like Flutterwave, Cellulant that are across multiple countries. And so those were some of the things like we really had to spend time looking at, and then leveraging partnerships as well, because you can't do it all as one entity. And I think David alluded to that, is that, as an entity, we needed to spend time understanding what is our roadmap, where do we want to be in 3 to 5 years, what is it that we can do as an entity, but how can we leverage partnerships to either acquire the licenses that we need to expand, to either obtain the infrastructure that we need, but also how do we leverage partnerships to obtain the data, the alternative scoring data that would help us to determine the credit worthiness of some of the customers that we wanted to acquire.
Thank you for that, Agnes. I think you've just highlighted on something that's really important, and that has to do with partnerships, but also that regulation makes doing business in Africa difficult, and we have a very fragmented market. I see that the tech team is alerting us with regards to time, so I would just ask that as we wrap up, our panelists can give us some very concise answers. And so I'd like to bring this discussion over to you, Miriam. With regards to regulation in Africa, does the fragmented nature of regulation in Africa, different licenses, different markets, does that make financial inclusion a reality?
Thank you, Karijatu. I mean, this is for me the key that would really unlock the potential for fintechs and microfinance on this continent. When we look at the regulatory framework across the continent, so there are different, first there are 54 countries, so that's a lot. And then you have regions that are organized and which are under the same banking regulation. So in East Africa, you have the East Africa community. In West Africa, French-speaking Africa, you have the WAEMU, the West Africa Economic and Monetary Community. So there is one banking regulation for 9 countries. Central Africa, you have the CEMAC, which is very similar. It's for the French-speaking countries in Central Africa. Beyond these regulatory regions, you have the major economies of the continent, Nigeria, South Africa, and they have robust regulations. And all the other countries that are not included in these regions that I highlighted are also subject to the national regulations. So which means that, for instance, if Agnes wants to provide services in the Ivory Coast, Agnes will need to do a lot of due diligence and to comply with the regulations in the WAEMU region. Same thing with Karijatu, if she with Fanta. If she wants to provide services in the Kenyan market, she will also, in addition to all her issues with digitalization, spend a lot of money to comply with the regulations in East Africa. So this is great for me as an attorney because it means that I can bill a lot. But to be practical, and really if the intention is to include as many African people in the financial system, it's completely ineffective. So, and another point which is important is that most of these regulations regulate traditional banks. They are really great with traditional banks. And there is a good exception, which is Kenya, and we are in a great country for that, which is a demonstration that you can have a regulatory framework which is friendly for the development of fintechs and microfinance. But that's an exception. So if I look at the WAEMU region, the French-speaking West Africa region, it's only in 2023, in June 2023, that fintechs have been officially acknowledged and defined in the banking regulation. So now they are included in the banking regulations. And it's a good thing for fintechs because they can now fundraise and develop their full potential. But the other side of that is that now they are subject to minimum capital requirements that are quite high. For instance, in that region, we're talking about $5 million US. That's a lot. So you can even see that just with the regulation, you can give the opportunity for fintech to go fundraise, and you can also limit the capacity of most of fintechs to even have the ambition to start the initiative. So that's an example. In Nigeria, for instance, what I know about your jurisdiction is that the services that are provided by fintechs are regulated, but fintechs as institutions are not. So, which means that they really have to be careful when they offer the services to the public. And they really need, they actually work on eggshells because they can be subject to sanction because they can provide services. They have a technology which is very, which moves faster than traditional banking. So they are always ahead, and they usually provide services that are not regulated yet. So we are I would say we live on a continent where I believe microfinance and fintechs could make the greatest impact ever, more than anywhere else in the world. And unfortunately, the regulations that we have, and I generalize, maybe there are few exceptions, but the regulations that we have in our African countries do not really, I would say, nurture the potential of all these fintech or these entrepreneurs to really service and provide the possibility for African entrepreneurs to have access to finances and to the financial sector.
All right.
Thank you.
As we wrap up, just to highlight this conversation about regulation, and if the tech team could just give us a few more minutes to wrap up and possibly a few questions. I just wanted to come back over as the last phase of this interaction to you, Jeremiah, and talk about, I know Agnes spoke about partnerships in a very fairy tale manner, but I'd like to know from Development Bank of Nigeria, if you've embarked on any partnerships and what the outcome was that, just under a minute.
Yeah, thank you. Very great point. And now I think Agnes and, Miriam has made very great point that, and this feeds into the question that I've just been asked. Now, for Development Bank of Nigeria, what is key for us, metrics for success, is your social, economic impact, and financial inclusion. And those are interpreted in terms of, how many MSMEs are you reaching, jobs they're creating, access to finance that you are sort of unlocking, and all of that. And so very quickly, we knew that if you look at our portfolio today, we have done, like I said, 787 billion, but we've touched 495,000. When we dissect that number, we realize that 80% of that money has gone to the bigger banks, right? Now, the microfinance bank has gotten like 20%. But the flip in terms of impact happens, and we see that the microfinance banks are driving more of the impact. So more than 80% of the reach, right, in terms of impact, in terms of number of SMEs, is coming from the microfinance bank. So we already know that because scale is important for us, we want to accelerate this impact. We know that there's a huge critical role the microfinance bank are playing with respect to, the impact that we're looking forward to. And so we, as a wholesale lender, one of the things we knew very, very earlier was that we needed to ensure that the funnels, because, a wholesale bank, so think about it like I'm pouring water in a funnel, and the more I can open that funnel, that pathway, the more I can reach more SMEs. So we said to ourselves, if we really want to scale and we really want to make our accelerator impact, then we need to sort of expand that funnel. And so we knew that we were working with microfinance bank, great, but how about the fintechs? So there was a clear strategy ab initio to work with the fintechs to see how they can quickly scale. Because with some few amounts of money, they can actually scale our impact. And we knew that very quickly. But here was the problem. Now we wanted to talk to fintech, and we're talking about regulation. Miriam made a strong point. We wanted to go to market, and then we realized that within our regulatory framework, we are only supposed to work with a regulated entity. And the fintech in Nigeria, like Miriam correctly mentioned, are not regulated. Their services may be, but in terms of the institutions in themselves are not regulated. And there's no regulatory framework for fintech. And part of the problem you must have mentioned is also the fact that the current regulatory framework for banks and other financial institutions cannot work for fintech. Because of the nature of it, the nimbleness, the fact that you must not stifle the innovation, but yet you also want to make them, a bit stronger, regulatory-wise. So there is a need for us to have regulation. So strategically, we wanted to partner with fintech, but the conundrum was that regulatory-wise, we couldn't partner with them. We had to find creative ways to incentivize our banks to talk to and work with fintechs, but directly we could not at the time. And part of the advocacy is to say, how do we get the CB and the central bank, I know there are conversations around it to say, let's have a sandbox, let's get the fintechs in within a controlled environment, let's see how this works, let's create some frameworks around it, is important. And really, we believe that because, and again, the benefits are there. They're quicker, they're faster, they remove the collateral. And these are traditional barriers to access to credit. Collateral is one of the biggest, and with, you talked about the credit scoring, model, alternative model. These are very, very innovative things and ways that can quickly accelerate credit. And we know that's ab initio, but how do we ensure that that innovation mainstream through fintechs can also be included into the financial services within the regulatory framework, and that we can then mainstream financing across the SME space. And I think that is very critical for us, and we're engaging with the regulators, with all our development partners to see how that can be done, because we think that that's very critical for us.
Thank you. Just as we wrap up, I'd like to know if there are any questions from our audience.
Yes, thank you, Jeremiah. And I just want to add something quickly on the regulatory perspective. It's yes, right now, the way the continental regulatory framework looks like is not very attractive for fintech, but there might be a way out of, and I'm thinking as an attorney here, a way out of this position, because we are a bit stuck. So you probably know that you probably heard of the digital, the protocol for digital trade of the African Continental Free Trade Area. So it's true that it's a protocol which purpose is to accelerate digital trade across the continent. But if you talk about digital trade, you're talking about payment, you're talking about digital solution to transfer money. And this is where I believe fintechs could engage with the AFCTA to make sure that at the continental level, there is a policy that can allow organizations like the one that Agnes run or microfinance for Fanta to really, I would say, still have the national legal, regulatory framework and the regional one, but for Pan-African transaction, they could rely on a Pan-African policy. I think that's really a critical moment to engage with the AFCTA and to be part of that conversation that is happening now. Because the protocol for digital trade has been published in February this year. So it's a now conversation. So that's what I wanted to add.
Thank you for highlighting that, Miriam. If we have a few questions. If you could just introduce yourself. And
good evening. My name is Phyllis Kamau. I'm the head of Visa Government Solutions for Sub-Saharan Africa, based out of Nairobi. But this conversation is good because it's taken me back maybe 6-7 years ago in my career when I was a lawyer in the streets of Nairobi. And at the time, in fact, I wanted to correct you that even Kenya has taken lobbying and experts in the industry to move regulation. At the time, we joined with Tala, you know, Rose, and we formed the Digital Lenders Association. We lobbied the central bank until we got the regulation. And by the way, central banks across actually regulate activities. And when we approached the last governor, he actually asked us, what is fintech? What do you mean by fintech? And we need to start unpacking that. What is fintech? You know, even banks are fintechs because fintech is financial technology. And so we needed to start unpacking, like, what is the activity we are asking the central bank? It's digital lending. And when we started that conversation, we started the conversation with the central bank around digital lending. This is the activity that should be regulated. And so as lobbyists, as lawyers, as people in the industry, we must move our countries to take fintech regulations and provide the right environment for fintechs to thrive. I like your discussion on the Pan-African level. There are two things that we need to keep pushing for. One is harmonization, which is critical, and I hope that the FinTech Association, Pan-African, we can participate, Tala and the rest. I left the industry. I wish I was still there lobbying, but I'm now at Visa. The second thing is, and I've seen what we've done as Visa. Visa is a FinTech. It's a global FinTech. And one of the things we keep pushing for to allow our business to scale is home country recognition. That when you are regulated in your home country, that the other country must at least recognize the regulation that already you have come from this country with. And because we have, you know, mechanisms like the AFDB, you know, where governors are meeting, or the protocol that you're talking about, there has to be a mechanism where we bring home country recognition. That this central bank can even allow me to start on the strength of what I have come with, and then they can, you know, they can then check, because they should have confidence with another regulator from another country. So, you know, and so those were my two key points. Sorry, it wasn't a question. I'm passionate and really thank you that, and I'm happy I sat through this. Thank you.
Thank you so much for that. If one word could describe that, it would be harmonization. Some really great insights from our audience. Are there any other questions as we wrap up?
Mine is to Jeremy. I'm not sure if it's a question or... Oh, hi. My name is Salma Ibrahim. I run an organization called Business Week Africa. So at Business Week Africa, what we do is we do capacity building for entrepreneurs. And what we offer them is knowledge and skills just to make sure they're able to run their businesses well. We are in 5 other African countries. And one of the main things that we do is you usually have annual gatherings for entrepreneurs in different cities of the continent. This year, we're going to have our annual gathering for entrepreneurs in Nairobi. All of you are welcome in August. Anyway, I wanted to inquire about the SMEs. You said that 90% of businesses, especially in Nigeria, are SMEs. And I wanted to inquire about how do you prioritize capacity building, especially when it comes to access to knowledge for the SMEs, because I'm sure there's a very big percentage of these SMEs that are actually grassroots, and making sure that they have the knowledge on how to run their businesses well, and also how they can be able to access these funding opportunities. And when they get to access these funding opportunities, we don't have cases where they have the funding opportunities. You give them the money, but they don't even know what to do with the money. They don't know how to manage the funds. So how do you prioritize capacity building, especially access to knowledge to these entrepreneurs? Because they are very large customers when it comes to now cash flow within the fintech society.
Okay. Thank you so
Under
much.
a minute, please, Jeremy.
Thank you so much for the question. There's no better way to prioritize SMEs for us as DBN other than to tell you that it's one of the fabric, it's woven into the fabric and DNA of the institution. We have 3 mandates. One of it is on lending. I've spoken about it. You need to provide capital. The second is risk sharing, very important. You need to incentivize the players in between to provide capital. The third is technical assistance and capacity building. These are the 3 pillars that DBN's mandate rests on. So it is strategic to us. And on that 3rd pillar, technical assistance, we provide, so we do it from, and this is really key because we try to close the loop. We do it from both ends. The supply of capital for the banks, you need to know how to lend to them. So your frameworks, your structures, your products must be right and must be tailored to SMEs. But then we go to the SMEs. That's now the capacity building. And we say, SMEs, you need to know how to use the money. So you're right. So we have these annual trainings. We train them. We've used digital to also scale up our trainings. So far in the last 5 years, we've trained about 5,000 SMEs. And we have that desire and mandate to actually scale up that training. So we're committed to it. It's our mandate, and it's one of the things that we do because we think it's very important that they know how to use the money when it's available for them. Thank you.
Okay, I'll ask you to keep your question very brief
It will
because
be
we're
very,
out of
very
time.
brief.
Thank you.
I was just wondering, I never had any of the fintechs talk about access to your cost of funding, which I think is also something that is a huge barrier in terms of your ability to scale.
Okay, I'll just ask Agnes to give.
I really like that question, because it is such an important question, and it's something, when we talk about some of the challenges we're experiencing today in terms of scaling beyond where we're at and being able to serve, other segments of customers, that becomes one of the pain points, right? So today, when I think about our cost of capital, in most cases, what you'll find is that fintechs are going to banks, right, to get funding, right, which they will proceed to lend to their customers. We know here in Kenya, the interest rates at banks have continued to go up. That is also impacting me, which is also impacting my credit margin, right, and my contribution margin, which then means that if I'm looking to extend or if I'm looking to also reach or expand my reach and also serve other segments of customers, it becomes really difficult. And so the question then becomes, how do we partner together with entities like the Africa Development Bank to be able to help us maybe come up with some sort of like blended capital or blended financing, which helps to de-risk us as we look to, reach out to more riskier segments. Because at the end of the day, we also want to be able to support most of these businesses, micro businesses in the informal sector. But the reality is, because it's unsecured lending, then we're talking about riskier business. So I'm very happy to have the conversation around how do we work together to be able to access more patient capital so that we can be able to serve and reach a larger market.
I think since we are sort of running out of time, I'll ask you, Fanta, to keep this extremely brief, and then we can close off.
Okay, no problem. I'll be very fast, okay? I will give you guys your time. Thank you for your question, and Agnes, you said a lot of the key points. Usually when it comes to the cost of funding, you come here and be like, yeah, we're doing this, it's great, it's great, it's great. We don't realize that it takes money to make money, and it takes money, you have to have money in order to give money. So we have all these big plans, we want to be digital, we want to be this, we want to be that. But before you become digital, you have to expend a lot of cost, just related to financial inclusion in a way that you have to train the people internally and externally what it means to be digital, why it's important, and how it's going to help them. That alone generate a lot of operating costs. And then you become digital, you acquire all of the technologies, the hardwares, the softwares to become digital. That alone will cost you a lot of money. And that's when you cannot look internally. And that's why a lot of the time, and tying it back to like regulations and stuff, which have changed from microfinance institution, required for us to now have a higher capital to operate, going from 500 million francs CFA to 3 billion francs CFA. It's needed because of the cost of capital, the cost to operate. You cannot operate alone. You need external support. And it's, like she said, it's the African Development Bank and other institutions like that that do generate help for institutions like either fintechs or microfinance institutions. I'm trying to be very fast to give everybody their time back, and I hope I answered your questions.
Thank you for the speed, Fanta. Just as we close off, Elizabeth will give a few closing remarks. But in closing, I'd like to say thank you so much to our audience for being so engaging. Thank you to our wonderful panelists, and thank you to our online audience. For the online audience, please feel free to post your questions in the chat, and we'll re-engage our panelists who will be able to give answers to some of your questions on LinkedIn. Thank you so much. Asante sana.
Well, I want to add my thanks to our panelists. Thank you very much for an engaging discussion. Thank you to our audience. Thank you for the comments that we got from the audience as well. And like Karijatu said, for those of our audience online, we will definitely make sure that your questions get answered. So in wrapping up, I just want to say thank you to all of you that have spent time to listen to us today. What we have done today is to sow a seed. It is the beginning of a collaboration. What we are intending to do is to keep up this engagement. We intend to do a post-conference report where we identify all the key issues we've identified that we've discussed that is going to actually impact on financial inclusion and economic empowerment. And we're going to try and follow up with all the different sectors of the market to see how we can really help make an impact. So please stay in touch with us, share your contacts, and visit our page on LinkedIn, and so that we share the report with you, and we will carry on this engagement, and we also will engage with you to see how you think that this can help us move towards our shared objectives. So I just want to close by thanking once again our speakers. I thank the African Development Bank for giving us the opportunity to host this. And I also want to thank all members of the African Development Bank who have worked tirelessly behind the scenes to make this event a success. Thank you to all of you. Thank you. Thank you very much. Because it's not easy, we know. And we know what we have done and all the demands we have made before now to get to where we are. So thank you. Enjoy the rest of the evening. And please stay in touch so that we can continue what we started today. Thank you.